Good afternoon, everyone. Good afternoon. Oh, thanks, Joyce. Good afternoon, everyone. I'm so excited to see everyone here in a mostly female-packed room. I'm Erin Lyons, FIASI's president, and I'm so pleased to kick off our 6th annual Women in Fixed Income event today. As FIASI turns 50 next year, we want to ensure all here today, as well as those who are on Zoom, are aware of our mission, which is to educate and bring together the fixed income community, and how we execute on that goal through all the wonderful programs that we offer at FIASI. We offer these programs to both our members and the broader community, so I hope everyone here checks out our website and sees what else you could be joining us for. Wi-Fi, as we like to call it, is one of our 3 hallmark events, the others being the Sustainable Finance event in the spring and our Hall of Fame dinner, which we brought back last year for the first time post-COVID, which we hold in October. Wi-Fi highlights experts in their field who just happen to be women, and it's appropriately timed this year to help give us insight as to what might happen in 2024. I invite everyone to join us on February 15th for our next event with Dan Fuss, the Vice Chairman of the Board of Loomis Sales. He will be in person here in New York. We also have that constant roster of events that everyone is welcome to join. So this event today wouldn't be possible without Joyce Cheng's vision and dedication to promoting fixed income and FIASI and women all over the world. Joyce and Margaret Canella spearheaded the inaugural event in 2015, which I was fortunate to attend. And our attendance and reach has only grown, much due to Joyce's very hard work. We are lucky to have Joyce on our board of directors, and she continues to be the mastermind behind this program. And Lauren Nauser makes it all happen. A huge thanks to you both. Today, we're really honored to partner with the New York Federal Reserve, and I extend a heartfelt thank you for providing this wonderful space and the opportunity to hear from your leadership. Thank you to all the fantastic speakers. We have a nice front row panel sitting here. And if you want to hear more about our speakers today, check out their bios on the FIASI site. There's also a QR code that you can scan and read those right away. Our program today first includes 2 speakers from the New York Fed, Michelle Neal to welcome us, and Julie Remache, our keynote speaker. Following, we'll have 2 markets-focused panels and then a fireside chat discussing how we can all promote diversity within the fixed income services. So a little bit about our first 2 speakers. Michelle Neal is head of the Markets Group and a member of the executive committee at the New York Fed. She has over 20 years of leadership experience in financial services organizations. She's been responsible for leading and transforming businesses spanning large geographical and regulatory domains, as well as asset classes with an emphasis on digitizing businesses dependent on scalable and resilient infrastructure. Before joining the Fed, Neal held senior executive roles, including head of U.S. fixed income, currencies and commodities at RBC Capital Markets and CEO of markets at BNY Mellon. She also previously held leadership positions at Deutsche Bank, Nomura, Royal Bank of Scotland, and LedgerEdge. Our second speaker today is Julie Remache. Julie is Deputy SOMA Manager and Head of Market and Portfolio Analysis at the New York Fed. Remache oversees work related to management and analysis of the system open market account portfolios and analysis of financial market developments. She also works closely with the SOMA manager to implement monetary policy. Remache has held several leadership positions within the New York Fed. She has extensive experience designing and implementing policy tools to manage the balance sheet, having helped implement policy actions to expand the balance sheet, which I think everyone in this room is well aware of, and provide liquidity in response to the COVID-19 pandemic and the global financial crisis. Previously, Remache worked in investment management, and has experience in bank interest rate risk and liquidity management. Thank you again for joining us today, and I'm very pleased to welcome Michelle to kick off our event.
Thank you so much, Erin. Good afternoon, everyone. It's a pleasure to speak with you today at FIASI's 6th Annual Women in Fixed Income Conference. On behalf of the Federal Reserve Bank of New York, we are very excited to be co-hosting this year's event. This forum gives us an opportunity to engage with one another on issues that are top of mind across financial markets. It also allows us to reflect on the landscape of our industry and how we might build on the progress we've made so far in elevating women in fixed income, and more broadly across financial services. As head of the markets group, I would like to spend my time here talking to you about my reflections on our particular role within the New York Fed, what I have learned from my experiences and leadership roles in the industry, and how they dovetail with the pillars of this conference. As you might know, the New York Fed has several important responsibilities, including to implement monetary policy as directed by the Federal Open Market Committee. To that end, in the Markets Group, we conduct open market operations in global financial markets and monitor them for signals about the transmission of monetary policy. We work with our foreign central bank counterparts to ensure liquidity in U.S. dollar funding markets and help design and operate emergency lending facilities that have been critical in stabilizing the U.S. financial system and the broader economy during periods of crisis over the past 2 decades. This is obviously a lot, and somehow it's not even all of it. To me, it makes sense that these responsibilities would be assigned to the New York Fed. Effective and efficient monetary policy execution requires a practical and thorough understanding of the broad range of financial markets through which monetary policy operates. By locating the duties related to the execution of monetary policy here in New York, the Federal Reserve System benefits from the collective institutional knowledge, experience in financial markets, and deep pool of specialized financial talent in the place where it's most concentrated. The New York Fed's unique insights have been especially visible during periods of stress, most notably in the financial crisis 16 years ago and the global COVID-19 pandemic, which, it's difficult to believe, began almost 4 years ago. With that said, I'd like to acknowledge how fitting it seems to hold the conference here at the New York Fed, given this unique role in the Federal Reserve System, much like the city of New York and its place in the global financial system. Turning a little bit more personal, being the head of the markets group for the New York Fed has really been the pinnacle of working in financial services for me. And it offers a rare vantage point on monetary policy for many of the reasons I listed above. Our role in apprising policymakers on the developments across U.S. and global financial markets is to contribute to the Federal Reserve's role in meeting its dual mandate to maintain full employment and price stability. It is an enormously fulfilling role that comes with a lot of responsibility. I've held this position for almost 2 years now, and having worked in other leadership capacities across the global investment banking landscape, I'd like to share my thoughts with you on some differences and similarities that I've noticed in my time here. The environment today feels very different from when I first started working in financial markets. There were not many women on trading floors back then, and there were fewer women in leadership roles. When I reflect on my own experience, I count myself lucky for finding champions along the way and hopefully validating the support that they showed to me through delivery. When I reflect on my own experience, that said, I am well aware of the challenges associated with being a woman in finance, especially for the women who came before me in environments where culturally and structurally, diversity and inclusion were not recognized as essential components of the work experience. I am pleased to see continued progress and that more women now are positioned to provide sponsorship and support to the people that they mentor. The resulting changes in our industry's landscape are, in fact, reflected by the attendance in this room today, though there is certainly a lot more work still to do. With that in mind, coming to the New York Fed has been really refreshing for me. In the markets group and across my leadership team, I work with a strong contingent of talented professionals, including a significant number of women leaders who have built their careers by carrying out the Fed's mission. It's been different to my experience in the past, where the ratio has been skewed the other way. It's gratifying for me to work with so many capable and intelligent women leaders. And truthfully, we have seen gains in diversity at the most senior ranks in our organization. But I will note with humility that, like the broader industry, we are working to make progress on having a more diverse and inclusive workplace across everything that we do. And this remains our ongoing priority. So before I conclude, I wanted to express why I believe that diversity and inclusion are essential for us here in the markets group. Obviously, there is a moral imperative for diversity, and numerous studies have shown the benefits to both productivity and the bottom line. But personally, in my experiences in both the private and public sectors, when I'm in a room and I see people who look and sound the same, I'm sure that's happened to many people here, I start to see a problem. When we're facing the dynamic challenges that we come across in markets and economics, I want to hear different perspectives on how to interpret the data, new takes on old problems, and innovative approaches to tackle the challenges that lie ahead. One thing that has been true across all of my experiences is that people are every institution's greatest asset, and that is why, in my view, an inclusive culture is so important. I'm really looking forward to the discussions that we'll have today, including the last panel, where I hope to hear from you on how we can improve diversity in our industry and how we can create inclusive environments so that everybody, regardless of how they identify themselves, feels their perspectives are not only heard, but valued. And of course, I'm interested to learn about your views on markets, policy, and expectations, and the risks that you're thinking about, especially at this critical juncture. With that, I'd like to highlight some of my fellow women leaders from the New York Fed who will be participating in sessions today. Argia Sbordone on the macro outlook, and Anna Nordstrom on what lies ahead for markets. And now I'm pleased to turn the mic over to my colleague, Julie Remache, the Deputy Manager of the System Open Market Account, who will be giving this afternoon's keynote address. Thank you so much.
All right. Thank you, Michelle. Good afternoon, everyone. Michelle, your words really do have special meaning to me. My own career at the Federal Reserve Bank has really helped me see the importance of diversity to our success. I have benefited greatly from the consistent presence of skilled female managers and peers throughout my career. These women have served as role models, mentors, friends, and champions of my work. Their guidance and support enabled me to contribute with confidence when I took my proverbial seat at the table, especially when I was the only woman in the room. Not all women are so fortunate. As we all know, there's still not enough gender parity or diversity in financial markets. This event, and others like it, provide opportunities for women to build supportive networks to further those goals. My thanks to everyone here for making this gathering possible. As the world grows more complex and interconnected, so too do the issues we face. Everyone brings different perspectives to problem solving, shaped by their own personal experiences, and wide-ranging perspectives are increasingly essential to finding effective solutions. In my experience, fostering a supportive and inclusive culture is embedded in the Federal Reserve's work. This culture is one of the things that has kept me at the Federal Reserve for nearly my entire professional career. And drawing from a broad range of views is critical in my role as Deputy Manager of the System Open Market Account, where I help to lead the Fed's monetary policy implementation. Recently, the evolution and future of the Federal Reserve's balance sheet has become a topic of increasingly active discussion. Today, I will describe where the balance sheet currently stands, consider its various components, and suggest how it might evolve going forward. Central bank balance sheets can be technical and obscure, but we'll go through it step by step. Please note, the views I express today are my own and do not necessarily reflect those of the Federal Reserve Bank of New York or the Federal Reserve System. That said, let's get into it. The Federal Open Market Committee has set U.S. monetary policy since the 1930s. And for close to half a century, it has been mandated to achieve maximum employment and price stability. The New York Fed is charged with implementing monetary policy, mostly through open market operations. Historically, the Fed's balance sheet consisted of a relatively simple combination of reserves and currency on the liability side, and security holdings and loans to depository institutions on the asset side. Over time, that balance sheet has become more diverse and complex as financial markets have evolved. But at the end of the day, the New York Fed's core job, supporting the FOMC's efforts to achieve its dual mandate, remains largely the same. So how does a central bank use its balance sheet to achieve its key objectives? Here I see three interrelated responsibilities. First, central banks provide money for our everyday lives. People use Federal Reserve notes, the paper currency we carry in our wallets, to purchase goods and services. Banks use reserves, the deposits they hold at the Fed, to settle payments and as a safe and liquid asset. The US Treasury has a checking account at the Fed called the Treasury General Account, or the TGA, which it uses to manage its cash flow. These and other Fed liabilities are the foundation of our monetary and banking system, the lifeblood of our economy. Second, central banks adjust their balance sheets to support the stance of monetary policy. In the US, the Federal Reserve's primary tool for this purpose is the target for the federal funds rate, which in turn influences other short-term interest rates and broader financial conditions. At each meeting, the FOMC sets a target range consistent with its dual mandate. Then the Federal Reserve adjusts a set of administered rates, and the FOMC instructs the New York Fed's open market trading desk to conduct market operations that achieve that target. Today, two of the Fed's administered rates, the rate of interest on reserve balances and the rate on the overnight reverse repo facility, together establish a floor under interest rates, below which banks and other money market participants should be unwilling to lend. Third, and finally, central banks can use their balance sheets to address dysfunction in markets to support the transmission of monetary policy. The Fed, as the lender of last resort, can expand its balance sheet to address temporary liquidity strains. Historically, during periods of acute stress, the Fed has used a mix of lending facilities and asset purchases to restore functioning in critical markets. The Bank Term Funding Program, introduced last March to mitigate liquidity stress in the banking system, is the latest such example. Supporting financial stability in this way helps prevent broader crises. With these tenets in mind, I will walk through how the balance sheet reflects these three interrelated responsibilities through both assets and liabilities. I'll start with Fed assets. These are relatively simple. They're primarily loans and the SOMA portfolio. The portfolio includes security holdings acquired mostly through open market operations, and it's comprised primarily of treasuries and agency mortgage-backed securities. Operations like repurchase agreements, which are also part of the SOMA portfolio, and other monetary policy tools like the discount window and other forms of lending, can also be used to provide liquidity to the financial system when needed. When the Fed purchases securities or extends credit to financial institutions, the balance sheet grows. When loans are repaid or securities mature without reinvestment, the balance sheet shrinks. Now I'll turn to Fed liabilities, the base money that we provide to the financial system and the public. So what are these liabilities and how can they evolve? I'll divide this discussion in two parts, reserves and non-reserve liabilities, since their behavior and drivers can be very different. I'll start with reserves. The Fed is a bank to banks, and reserves are the deposits these banks hold with the Fed. The total supply of reserves relative to bank demand is a key part of interest rate control. Demand for reserves reflects actual or expected payment activity, regulations and related factors, and internal liquidity risk practices. Reserve demand tends to grow with the economy, and surveys suggest it increases around stress events. The Fed pays interest on reserve balances, also known as IORB, one of the two administered rates I mentioned earlier. IORB provides a strong disincentive for banks to lend out excess holdings below that rate, and thus acts as a floor on bank lending rates. On the other side, non-reserve liabilities can be further split up into two subsets, autonomous and semi-autonomous factors. I'll take them in turn. Demand for autonomous factors is driven by more by structural dynamics than the stance of monetary policy or other direct actions of the Fed. That distance from Fed actions is what makes them autonomous. Currency and TGA mentioned earlier are prime examples. Currency demand has generally increased over time, reflecting nominal economic growth, shifts in consumer preferences, technological changes, and international demand for US dollars. TGA balances are determined by Treasury's cash management practices and have grown over time, albeit with periodic fluctuations. An important subset of non-reserve liabilities is what I will call semi-autonomous factors, the size of which are ultimately determined by economic incentives, but are also influenced by monetary policy and its implementation. The overnight reverse repo facility is a prime example. The overnight reverse repo rate, the second of the two administered rates I mentioned earlier, effectively acts as a floor by offering safe short-term investments to a range of bank and non-bank counterparties, including some that do not otherwise have access to remunerated deposits with the Fed. Demand for the overnight reverse repo is driven primarily by money market dynamics. This includes demand for deposit funding by banks, asset allocation decisions by money market funds, and relative availability and pricing of other short duration safe assets, such as Treasury bills. Now I will turn to interest rate control and our implementation framework. In 2019, and again in 2022, the FOMC affirmed its intention to continue operating in an ample reserves regime, a framework that has been in place since 2008. The merits of this decision have been discussed in other forums and publications. I'm going to discuss our framework as a foundation for understanding the FOMC's current plans to reduce the balance sheet, as well as the likely evolution of the balance sheet over time. When reserves are ample, interest rate control is achieved primarily through administered rates without active management of reserve supply. IORB, remember the rate that banks earn on their reserve balances, disincentivizes banks to lend funds at any lower rate, and thus acts as a floor on money market rates. This system ties the price of liquidity to administered rates rather than to changes in reserve supply or demand. This flexibility allows the FOMC to use changes in the size or composition of the balance sheet as a policy tool while maintaining interest rate control and influencing broader financial conditions. This approach works well in both liability-driven and asset-driven regimes. When the balance sheet is only large enough to meet the demand for Fed liabilities, the regime is characterized as liability-driven. Assets are adjusted to ensure that the supply of reserves is ample relative to demand. This is an environment in which the federal funds rate does not display significant sensitivity to short-term changes in aggregate reserve balances. By contrast, the balance sheet is asset-driven when asset purchases are used to provide additional economic stimulus or to address severe market dysfunction. During periods of acute stress, backstop facilities or emergency lending tools also support market functioning and the smooth flow of credit. In this regime, the supply of liquidity may grow well beyond ample and remain there for some time. That means that there's an excess supply of reserves, possibly a significant excess supply relative to bank demand. This is when the floor provided by administered rates is particularly important. Our framework is also designed to maintain rate control through the transition from an asset-driven regime to a liability-driven regime. The overnight reverse repo is key to that flexibility. After the global financial crisis, it became clear that the floor on rates from IORB was a bit leaky. That was partly anticipated, and was attributed to bank balance sheet and other intermediation costs. It also reflected, however, the activity of the GSEs, such as the Federal Home Loan Banks, to name just one example. These GSEs participate in the federal funds market, but since they do not earn interest on the balances they hold at the Fed, it means they are likely willing to lend at rates below IORB. Overnight reverse repo reinforces interest rate control by extending administered rates to a larger share of market participants, including GSEs and money market funds. How does this work? When private market repo rates are below the overnight reverse repo rate, some counterparties are incentivized to use the overnight reverse repo and its balance grows. But when private market repo rates, are above the overnight reverse repo rate, the facility balance tends to shrink. This way, the overnight reverse repo enhances rate control by securing the floor under overnight funding rates, giving our framework greater flexibility. In the long run, the balance sheet will generally be liability driven. In other words, it will be adjusted primarily to meet the demand for reserves and non-reserve liabilities consistent with an ample supply of reserves. Today, we are in transition, reducing the size of the balance sheet as directed by the FOMC. This process is going smoothly, and I'd like to provide some context. In 2022, the FOMC reaffirmed that its primary tool for adjusting the stance of monetary policy is the federal funds rate. It also reaffirmed its intention to maintain over time security holdings and amounts needed to implement monetary policy efficiently and effectively in its ample reserves regime. The committee subsequently communicated its intent to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample. That buffer should provide space for the growth of non-reserve liabilities until reserve balances are at an ample level. Since the start of runoff in June 2022, the SOMA portfolio has declined over 1.4 trillion, including 1.1 trillion in Treasury securities and nearly 300 billion in MBS. The decrease was partly offset by a rise in lending after the stress to the banking system in March of 2023. On net, Fed assets have declined by 1.3 trillion since June of 2022. This runoff in SOMA securities is passive and subject to a monthly cap of 95 billion. That approach is designed to be predictable, and it's intended to reduce the risk of disruptions in market functioning or outsized volatility in asset prices. On average, security runoff has been about 75 billion per month, a level below the cap owing to the very slow pace of MBS prepayments. As I mentioned, balance sheet reduction has been proceeding as planned, and reserve supply remains above ample. The reserve draining impact of runoff has been almost entirely offset by the reserve adding impact of the drop in overnight reverse repo usage. And as a result, reserve balances are nearly unchanged since runoff started. Nevertheless, we are seeing incremental signs of shifts in money market conditions. The distribution of traded repo rates, for example, has moved upward. And repo rate volatility has periodically reemerged around regulatory reporting or Treasury settlement dates. However, there's no sustained material upward pressure in the federal funds market. As balance sheet reduction continues, we expect to see further declines in the overnight reverse repo, and reserve balances will likely begin to decrease at some point. As this proceeds, we will continue to monitor conditions in a range of money markets. Amid these developments, there has been increased focus on the factors that would guide a decision to slow the pace of SOMA runoff. The FOMC will ultimately determine the future evolution of the balance sheet, including when to slow and when to stop the runoff of the securities portfolio. Still, I can provide some context on how to think about its future size and associated considerations. Let me walk through that now. The balance sheet currently stands at 7.6 trillion, including 7.4 trillion in SOMA securities. According to recent surveys conducted by the desk, there's a high degree of uncertainty amongst primary dealers and market participants over how much further the SOMA will decline. Most respondents expect runoff to cease between later this year and the middle of 2025 and assign a substantial probability to a SOMA portfolio that is between 6 and 7 trillion when it ceases to decline. Importantly, the size and composition of the balance sheet will be largely determined by factors that are not directly related to monetary policy. Secular shifts in demand for reserve balances and other liabilities will be key. It is, however, clear that the recent trends point to a sizable balance sheet in the long run. Federal Reserve notes, which currently stand at 2.3 trillion, are a primary driver. Currency growth is likely to be steady, and technological change is a wild card. The TGA, which reflects Treasury's cash management policy, currently averages about $750 billion. But that may change over time and exhibit significant fluctuations. Meanwhile, accounts held by foreign central banks, other international institutions, GSEs, and designated financial market utilities have increased and currently represent about $550 billion in additional liabilities. Together, these liabilities total $3.6 trillion before accounting for reserve balances. Future demand for overnight reverse repo is an open question and an important one. Thus far, overnight reverse repo counterparties have been very responsive to private market prices, which is consistent with the facility's role in reinforcing the floor on rates through a wide range of environments. If these declines continue, overnight reverse repo balances could return to near zero levels over time, but that remains to be seen. Finally, the response of banks to changes in regulations and risk appetite has driven increased demand for reserves. The emergent stress among regional banks last March appears to have been a recent catalyst. The Fed will need to be responsive to this change in demand when setting the supply of reserves at a sufficient quantity to maintain interest rate control. Considering all these factors, a return to the 4.2 trillion pre-COVID balance sheet is very unlikely. In the coming months, we will be monitoring money markets for emerging pressures, which may at some point indicate that we're getting closer to a level that is somewhat above ample. Eventually, the balance sheet will have to increase over time to accommodate the longer-term growth of the financial system, and with it, the demand for Fed liabilities. In order to meet this growth over time, reserve management purchases will be needed to maintain an ample supply of reserves. To conclude, I want to emphasize the balance sheet reduction has been proceeding smoothly. The longer run size and composition of the Fed's liabilities will be driven by structural factors that will influence the demand for reserves and other central bank liabilities. This demand will continue to influence the size of the balance sheet needed to operate effectively in an ample reserves regime. For now, we will continue to monitor money market conditions to help policymakers determine when to slow and then stop balance sheet runoff. As I mentioned earlier, the tools may have changed over the years, but our goal remains largely the same: to help the FOMC achieve its dual mandate. We do that by taking actions to implement its monetary policy decisions. The balance sheet is, in a sense, simply a record of those actions. That makes understanding its past and its evolution key to understanding the role of the central bank in the economy, how it supports growth and employment, maintains stable prices, and promotes the safety and stability of our financial system. Finally, to bring it back to the conference today, I will leave you with a sentiment from current Treasury Secretary and former Fed Chair, Janet Yellen. She has said that expanding opportunity to women isn't just the right thing to do. It's also good economics, and we have much more work to do. As we look ahead to today's conference on so many important topics, let's keep this in mind and keep working towards a better future. Now I'd like to welcome the first panel to the stage.
Thank you. Okay, great. Good afternoon, everyone. First of all, thank you, Erin and Michelle, for your warm welcome. and Julie for your insights into the Fed's balance sheet management. It's really wonderful to see such a full room today, and we are honored and grateful to the Federal Reserve Bank of New York for hosting FIASI's 6th Annual Women in Fixed Income Conference. I'm Monika Aggarwal, FIASI board member and head of retail and consumer corporates at Fitch Ratings. I'm really excited to be here to moderate our first panel on the US macroeconomic outlook with our esteemed guests. So let me introduce the panelists, starting with my immediate left. We have Argia Sbordone, who's the head of macroeconomic and monetary studies at the Federal Reserve Bank of New York. We have Monika Mantilla, president and CEO of Altura Capital. Alan Zentner, chief US economist at Morgan Stanley, and Nancy Davis, founder of Quadratic Capital Management. As Erin mentioned, their full bios are available on FIASI's website. So thank you very much for joining us today, and let's get started. So 2023 was characterized as a year of US resiliency with robust economic growth, surprising to the upside, despite significant monetary policy tightening. Now that the FOMC has indicated that it is near the peak of policy rate and a slower rate of growth is expected, what do you see as the key watch points for 2024? So Argia, let's start with you, and then we'll go around and have all the panels comment on it.
And let me first say that whatever I say is my own view and not that implicate the Federal Reserve or the Federal Reserve System. Okay, yes, so the 2023 was quite remarkable. We entered the year with lots of forecasters were still having in their forecast the probability of recession. And then we end up with a very robust growth. Policy has continued to be restrictive throughout the 2023. The last increase in rates, as Julie reminded us, was in July, and now we are at the target range between 525 and 550 basis points. So in the meantime, inflation that had a big ramp up with the pandemic started to decline and peaked in the middle of 2022 and has declined since. So going into 2024, the question in the mind of everybody, are we there already? Can we turn the corner and start declining interest rate? So here I want to borrow the words of the chair, because I completely agree. The committee has seen all this good news, robust growth, the labor market coming in better balances, so that the pressure on wages is not as strong as it was before. But inflation, despite declining, is still in the range above the target. So what do we have to see, and what can we expect for 2024 in order to see the committee turning the corner? And here we have to see confidence, more confidence. The environment continues to be extremely uncertain, and the scenario can be of both ways. So we can have inflation continue to go to sustainably to the target of 2%, and growth remain relatively robust. Or there would be too robust growth and too much inflation coming back, or the economy can grow too slow. And so you have to balance the risks in order to look for. So what we are going to see, lots of attention to inflation data, sectoral inflation data, because the sectors are moving in different ways. We want to have keep an eye on the international situation, because it presents some risk. And probably I shouldn't get more time.
Great, thank you, Argia. Monika.
Thank you, and thank you to the Federal Reserve and for this great opportunity to have women in fixed income getting together and talking about the markets. I run, as you probably some of you know, a group of private equity and private credit funds, and in that context, I was invited to talk about what we see in the private credits market and what's happened in 2023 and what we see are will be happening in 2024. So the segment has, as you probably all have witnessed, an incredible strength, right? We're talking about, a size of a market of $1.5 trillion coming in 2006 from 400 million, and, an expectation of significant growth. Today, it's actually 12% of all global alternatives. So it's a segment that, given what happened in 2023 and what happened with the financial markets, with Silicon Valley Bank, with First Republic, it actually sort of catapulted the growth of the category. So we're seeing more growth coming ahead, more opportunity coming ahead. And I think that the resilience of the asset class is also a function of the service it provides, not only for institutional investors, because it's negatively correlated to equities and fixed income, but also because it serves a purpose in the segments where you're adding value to companies, just not simply credit, but credit plus, right? It's a very proactive approach. It has the flexibility with many of the mezzanine products to not just be, paying right away interest, having a very strict structure compared to banks. So it's an asset class that experienced growth in 2024, that will continue to experience growth. And we see just a very robust and interesting market, despite the volatility. And sometimes actually that volatility creates good conditions for the category.
Thanks. So the answers tend to be a little different for an economist on a panel. So I cover the macroeconomy, so my list is always like a factor of 50 things that I think are key to watch each year. And I just want to say thanks for all my females from Morgan Stanley being here. I see you in the very back. I see you guys way up there. Don't think I don't see you. So I'm looking at things like policy lags, right? It's the monetary policy. We've seen a lot of tightening. There's been the lingering questions in 2023. Why didn't we see more slowing from aggressive policy tightening? And so what are those lags? Do we still have lags to come through in 2024? So I think I'm really mindful of that, and credit conditions and bank lending conditions. I think when you look at wealthy spending, it was just on fire in 2023. And so will that continue this year? Are they starting to get sort of exhausting pent-up demand, or is there still a lot of appetite out there for spending on services, experiences, especially high dollar experiences? It doesn't seem like that's slowing yet. I'm looking at labor retention. That's still key for 2024. We were calling it labor hoarding, but I think labor retention is now just been decided that's a better term for it. Companies are still backfilling positions, having found it so hard to hire during the pandemic. And so they're not laying off, but they're slowing hiring. So how much more of that happens? We want to see they continue to retain labor. Will inflation remain lower? That'll tell you whether the Fed stays on hold, right? And let me just add, no small thing like election uncertainty, geopolitical uncertainty. Specifically, do we reignite China trade tensions? So those are the things that I think are key factors for 2024. And as any good economist, I'll leave you wondering whether I'm optimistic or pessimistic on here.
Great.
So I'm Nancy Davis. I specialize in the public fixed income markets, and hopefully a good complement to the rest of the panels to bring a perspective. From my vantage point, the markets are on fire. Credit spreads are near extremely tight levels. You've had a lot of fear of duration because the Fed did hike, so much in a 12-month period. A lot of investors have been moving into short duration portfolios. And if it's short duration government bonds, that's fine. But a lot of it has been moving into things with credit spread risk, or whether it's other types of structured credit. And so I think one concern that I see, if you look at, if you pull up your Bloomberg terminal and look at the investment grade CDX market, you can see the 3-year CDX is 30 basis points approximately today. The 5-year point is over 70. So you've had lots of money pouring into short duration, and credit spreads are so tight. I mean, they can only go to 0, right? So the risk reward to take additional credit risk right now And so I think what we're seeing, it was so interesting to hear about the SOMA holding, because the two options were slow or stop, right? Not increase. And there's still so much money out there. Obviously, the Fed has been hiking rates, but the quantitative tightening that has taken place, it's still been capped at that 95 a month. And then we've had with Silicon Valley Bank, we've recently had the New York Community Bank as well, but that BTSP program is expiring March 11th. So that's been sort of also fueling the amount of money in the system. And I'd say credit is on fire. Credit spreads are incredibly tight. It's a pretty dangerous time to be in the fixed income markets. If it's government bonds, it's fine, but I just don't think investors are getting paid a lot to take additional risk in credit markets, given how much liquidity the Fed still has in the system.
Thank you, Nancy. Maybe if I could follow up, Argia, you mentioned about the delicate balance. So, how do you view the balance of risk and potential for further upset surprises? What are your thoughts around the market expectations about the timing and magnitude for policy easing and the likelihood of a recession?
Well, as we mentioned and Ellen mentioned, we have had a very strong consumption. So consumption has supported the whole economy. So now we are in a situation in which all the factors that have supported consumption may start fading. One support has come from a strong labor market. At the same end, the strong labor market are provided the workers with higher wages, so capacity to spend. There was some excess savings that probably is still in the card. And there's been some fiscal support. There was still, we don't know what's going to happen with the payment of the tuition for the students, all the loan repayment. And we start to see, so there is the possibility that the buoyancy that has surprised us on the upside may continue. On the other hand, it's possible that all the factors that supported consumption start to fade. And so we can have a potential situation of consumption growing again faster than expected, but at the same time, we have the possibility that, wages start to moderate and the consumption becomes cooling and can cool maybe too fast. On the other side, on the inflation side, there are also some risks, of course, because inflation has been declining, and now people talk about the last miles of the inflation. So that it is true that now the sectors in which inflation has not come down are the sector in which prices are more sticky, and so it may be possible that it's a little harder to bring inflation down. And so if you don't bring inflation down, the committee is determined not to let the grip on the economy to go. And so that may create a situation in which growth may be hit by the objective of bringing inflation to this 2% sustainable path. So the risks are both sides on growth and both sides on inflation. And so it's a delicate balance to navigate with the policy that is not too tight and is not easing too fast, too soon. And that's the expectation of market are pretty much aligned to what the committee has announced, not quite announced officially, but has there were in the December, the SEP, there were still about maybe projection of 3 cut during the year. Now, after that, we will see a new SEP in March, so there will be more of a sense of what a committee is in terms of the path of the interest rate. And the markets now I've seen also strong labor market that has reduced the projection of many cuts. There were about 5 or 6 in the market forecasted for 2024, and now I think they are back to 4 probably, which is more aligned to what the committee has anticipated. The communication seems to be percolating to the market quite effectively.
Great. Ellen, do you want to comment whether optimist, pessimist around this, or?
Oh, I'm a little bit of a Pollyanna. Isn't that terrible? It's because I'm from the South and we get the sun all the time. But yeah, so I moved up to New York 20 years ago and was accused of being a Pollyanna economist. I can't help it. We will have a recession. We've just been talking for years about when. When is it going to happen? I don't like the no landing or what landing or whatever we're calling it now. There will be a hard landing. It's just a matter of when. And there's still a lot of support for a soft landing out there. And part of that is that the Fed has reached a peak in rates that they're comfortable with. They're looking around. They can see that the coincident, the data incoming and the forward-looking data are not pointing to something sinister lurking around the corner. Growth has been surprising to the upside. How much of that is supply driven? That's a good thing. We've had a lot of severe COVID distortions, and we've got really strong job gains. Well, that's more supply of labor. We've had really strong GDP. That's great. The supply side is coming back. We've got manufacturing numbers that show manufacturing is pulling out of recession. We've still got healthy balance sheets supporting households. I do think that we can squeeze more out of this relationship of decelerating inflation amid still strong growth. But what does that mean for a policy prescription? It means you remain patient and you remain on hold. God forbid you declare victory and get egg on your face because something happens and inflation reaccelerates. But you had mentioned the SEP. They are going to have to update their March projections. Chair Powell's already said prepare for downward adjustments to the inflation forecast. We made downward adjustments to ours. We've been getting some forward-looking data on rental prices, suggesting that you're going to have some of that easing come through further in the back half of the year. So I think right now we're set up for a good environment as a backdrop for the economy.
So while
Exception.
you started saying we're going to have a recession, you started with a very firm. Okay.
I'm
well, we
convinced
don't know
we're
when.
going to have
okay.
a recession.
Okay, so
I can
your
tell
path,
you we're going to have a recession.
your path is on optimism through
I'm very
2024.
optimistic it's not coming this year.
Okay, that makes it clear.
Okay, well, so we have a view now. Just timing may be a bit uncertain. So maybe just kind of staying on that theme about, the resilience. Maybe Nancy, if you could kind of, maybe address, there's been speculation about what factors have fueled the strong U.S. Growth in recent years. I think we have touched on a number of them so far, and the question is whether they will persist. So what is your perspective, on this renewed resilience, and how do you expect the environment to evolve?
Yeah, definitely the financial markets are very optimistic. They're very optimistic for a lot of things. Things are expensive. They're priced for, not for a recession, for continued growth. People are right now have FOMO again. They're back out chasing yield, chasing returns. You can see that in the level of volatility. And I'm not just talking about equity vol across all asset classes have fallen substantially. Even things like interest rate volatility is way below levels around Silicon Valley Bank, even though we just had another community bank come out and drop 40% in the stock market. So markets are very complacent, financial markets, I mean. But you have other markets that are kind of screaming there is going to be a recession, and that's the yield curve. The US dollar yield curve, whether you're looking at the Treasury market or the SOFR swaps market, is still one of the most inverted yield curves in the entire world. Japan, for instance, which was doing yield curve control, they did have a very, very dovish central bank for probably way too long, and they're experiencing actually a little bit of inflation finally after decades of trying. Their yield curve, the JGB curve, is about 70 basis points positive. And ours, if you're looking at, say, the 2s10 SOFR curve, is negative 60 basis points. And so I think that's an issue because at the end of the day, yes, the private credit markets are robust. There's a lot of allocators looking for, kind of this non-correlated return. But at the end of the day, you want the economy to be extending credit, right? The Fed doesn't extend credit. You need the rest of the world to be lending to get businesses and innovation and growth. And when you have an inverted yield curve, why would you lend money for longer and get paid less, right? That's kind of the definition of crazy. It doesn't make a lot of sense to have an inverted yield curve, right? Like think about just even the Treasury market. you can buy a 1-month T-bill and get paid 5.4, or you can say, here, US Treasury, let me give you money for 10 years and get 4%, right? So it's, a substantial difference. So I think that's where I think the balance sheet, the SOMA piece of the holdings of the Fed's portfolio could really help normalize the yield curve to help the extension of credit to go out into longer dated loans. Because right now, everybody is hanging out in short duration. And I think the problem with a short dated loan, think about if you were the treasurer or CFO of a corporate and you had a loan expiring in, say, a year or 2 years, you're very sensitive to that amend and extend, right? You either have to pay it back or you have to restructure it. So having an inverted yield curve is really unhealthy for the extension of credit. And I think that's going to be a problem. Maybe that's going to be the recession that Ellen's talking about, because the yield curve, it's often, is it a chicken or an egg? Is it the sign that a recession's coming, or is it the cause of a recession? We don't know, but it's highly correlated. So I think because the US is such an outlier with the US yield curve being so inverted compared to even the rest of the world, it's not a great sign. And I think the Fed could do more with their SOMA holdings to help normalize and actually extend credit into longer loans.
Okay, great. Anyone else want to kind of comment on, the renewed resilience and how you expect the environment to evolve?
Yeah, I know. When we were preparing for this panel, one of the things that was brought up immediately is, the contrast between the macro and then us in the trenches, right? Investing in companies and then segmentation, right? Because we're actually investing in the lower middle market, right? So think about it, companies that are from $1 million to 10 million EBITDA, that we're coming in, but we can double or triple their size. And so what does these macro trends mean for us? Well, growth in fixed income credit, private credit, huge. And so that spells tremendous amount of opportunity. Sector conversations, they're definitely, we're sort of braced for inflation, braced for recession, and having to put all that into our recipes. But definitely, for example, healthcare. We're in 4 segments and always, looking at opportunities in consumer, in manufacturing, in business services, and in healthcare. Healthcare has been one of those segments where we see tremendous amount of growth, tremendous amount of opportunity. But what are the key factors for us? It's not the macro, because we're sort of, thinking about every possibility. It's the strength of the management team, right? It's the strength of the partnerships that those small businesses can create with larger corporations to be able to secure long-term contracts. So the skilled manager in good and interesting markets that experience growth are a great opportunity for us. We've always seen it also as the biggest kept secret in the recipes for a successful economy. Bring more capital into small businesses, into lower middle market. Give them the opportunity to do longer relationships when we've had a 15-year history of having small businesses team up with larger corporations. So we're a lot more than in the macro, and we're sort of braced for that, but always thinking about our ability to add value is that systematic approach to finding the right companies with the right management team, giving them the right operational support around how are they going to grow their revenue, how are they going to make their management team better. And so it's a story where, if anything, in the conversations with the Fed, we've always said, give us more research, because there are a number of trends that happen in this market that very frequently are not captured. And I think that putting more attention, more research into those small businesses, lower middle market businesses, and the opportunity there is there to build value is huge for the economy, and it's systematically overseen, underseen, underkept. So those would be my thoughts about segments, seeing a tremendous amount of growth in these markets, but also wanting more resources and more collaboration to happen so they can really, bring to the market the value creation opportunity they hold.
Right.
If I could just underscore there how opaque the lens is on small businesses. So from a practicing economist perspective, we get a lot of surveys, we get some very delayed data that a year later we'll get details on businesses. We do have more frequent data that comes out on business formations, and especially those with more durable employment. But it is sort of a murky lens. And for an economist, it's always a source of uncertainty because small businesses do employ the bulk of the labor market and are the biggest generators of job gains. I think one thing that I was really heartened to see in the most recent Senior Loan Officer Opinion Survey, lovingly called the SLOOS. And so when the SLOOS came out, it showed that commercial industrial lending, which has been extremely tight, had gotten less tight. So it's still tight, but it's a little bit better. And then demand for commercial industrial loans had picked up from very low levels, but picked up. So a little bit of an encouraging sign there because commercial industrial loans are how small businesses fund equipment, fund inventories, fund payrolls. So I think it's still a very tight environment, but there's a little bit of loosening there.
Yeah. Actually, you know, I think this really segues well into kind of the next topic, which is that, you know, as we think about, you know, monetary easing in the developed markets, it is really, it's going to either come from, you know, a break in labor markets or the financial market stress threatening expansion, or just around the confidence around that. And, you know, inflation can be sustained below 3%. We'll kind of get to the inflation, but keeping on the topic of, you know, the labor markets, Ellen, maybe you could kind of provide your perspective on how the U.S. labor market conditions are today, and what do you see as likely catalysts, either for higher unemployment or, you know, maybe thinking about the sustainability of the rise in labor productivity?
Well, I've been surprised at how many jobs we've been creating. We've had a forecast that jobs will be slowing, and it just keeps getting pushed out to another day. We had revisions that came on Friday, and I think the most surprising was not necessarily that job gains remained very strong, but that the last 3 months suggested maybe the decelerating trend has stalled. We have a lot more people that are coming from outside of the labor market directly into jobs, which is really interesting. That's hard to measure, but it also means that the labor market has been tight enough that you're starting to get more into the cracks. So that's probably a healthy sign, and not a sign that I think the Fed would look at and say, wow, that's too strong. The gains on Friday were very broad-based, so it didn't look like a particular weather event. It didn't look particularly like, well, it's all due to immigration, because immigration flows have really picked up. And so, you know, you didn't just see job gains in areas where immigration tends to go. And so that is a puzzle that probably has many missing pieces that we still need to fill in. But for monetary policymakers, it's going to go back to, is that a good sign that the supply side continues to improve? And I'm positive on labor productivity. I want to give a plug to the New York Fed's event. I think it's on February 15th, the Productivity Day. Please, the 16th, please join. It's, I mean, I'm not on the panel, but please join. Maybe that's my plug. There are 3 panels that day, all covering productivity, and it just looks like a phenomenal lineup of speakers covering it from different angles. And Mr. Productivity, Bob Gordon, is going to be on that 3rd panel, I noticed, so that's going to be very interesting too.
Any other thoughts around labor?
All these issues, you know, how much the AI, you know, I wouldn't call revolution at this point, just the evolution is going to impact productivity, how much this different type of work that we do that we will cover in the panel, you know, the new way we work, right? We work partly remote. Maybe we have adjusted now to this different way of working, how much we use the technology. So all this impact productivity, which has been very strong recently as well. And so the question is, where is this going to be? And I'm curious to hear about Gordon, which is typically pessimistic about.
I think we could talk about AI and technology all day, but maybe we'll just kind of move, you know, back to the topic of inflation, you know, as we think about what might happen in the markets. And I think we've all kind of commented on the fact that while inflation has significantly, you know, declined from last year, it does remain above many central banks' inflation target, including the FOMC's 2% target. So Argia, you know, how do you assess the risk that inflation could rebound or remain elevated given strong consumer trends, the wage pressures and concerns about housing, and could the decline in core inflation just be a stickier process going forward?
Yeah, I briefly refer what people are worried that inflation has declined very rapidly because once the commodity prices have gone down. So this first effect has been now vanished. Now we are with the core part of the economy, core goods, core services. And here, they are behaving quite differently. Core goods are declining very rapidly. Now the inflation rate is much lower. We are in deflation for the core goods. Core services are more sticky, but big part of core services comes from the housing services. So the rents are a strange object that they come slowly with a lag into the index. So to have the full effect of the increase in rent that we had at the beginning of the pandemic and then the decline now, we still have to sort of wait for the data. Here we have one way to look, and we see relatively bright future for inflation. We look at measures that assess the persistence of inflation. So we go beyond the classical data. We try to see how much persistence there is. And this degree of persistence, it was very high. It reached a peak in the mid of 2022. Now it has declined. So when we see the persistent declining, we have more comfortable, we can see more confidence. So the future of inflation should be judged on this. So, and the risk should be judged on what happened. Inflation expectation have come down quite, well. We have a survey here at the New York Fed, that's probably very well known, the survey of consumer expectations, both the long-term and the short-term, particularly the short-term inflation expectation had increased with the increase in inflation. Now they are all back to the pre-pandemic trend, and long-run inflation expectations are stable. So there is a good reason to think from the data that we see today, from the persistence that we see in that inflation is on the way of a sustainable path for 2024 or early 2025 to reach the objective. Of course, the uncertainty there depend on the service sector mostly, the labor costs that are more important in the service than in the good production firms. The cost of labor has increased, wages have increased, and as we were saying before, this has sustained the strong consumption. It's been a component of the strong consumption. Wages now have started to decline, but the decline in the recent month has stalled a little bit. So here, it's an important factor. Labor costs, whether the labor costs will continue to sustain the decline of inflation by being more moderate than there was. Of course, with the strong labor market, you can assume that wages will be declining too fast. Last, you mentioned the housing. So we have, mentioned that the rents are now coming down, but we are not seeing the full effect in the data because the new leases enter with lag in the measure of rent inflation. So that we expect a decline, and we have to see more data on that. There are uncertainty also. Some pessimists think that the geopolitical situation may create disruption again in the supply chain. So if we see disruption in the supply chain, that can reflect in the price of goods that we produce, because those are the inputs in production matter. So that's an uncertainty also on that respect. I don't know if
I'll say something on inflation because I actually have a question for Nancy. So growth has been very strong, and we do have a forecast that you do have some stickier services inflation here. We've got core PCE reaccelerating in the first quarter, and that's one reason why we continue to call for and have been calling for the first cut in June, that the Fed doesn't begin cutting until around the middle of the year. Thank you, Chair Powell, for also being so clear, and which helps, although our view was before that. But what I've seen is a change in narrative among investors. Now, it's probably still a small pocket of investors, but we seem to have gone quickly from, gosh, the Fed's going to have to cut soon and quickly, to, wait, growth is so strong, and look at this jobs number on Friday. Is a hike the next move than a cut? And it still seems to be a small pocket of investors, but I'd love to hear how those risks play out, you think, in the market, because the markets are always, they speak a different language than monetary policymakers.
Yeah, no, it's, can you guys hear me okay? Just checking in. It's definitely inflation expectations in the future are pretty symmetric around 2%. There's not a big fear that we're going to have, sustained inflation for long, but it is very interesting because everybody is kind of front running the Fed. All bond managers, all public markets are sort of, you can see it with the inverted yield curve saying, okay, cut, we're going to get super long duration waiting for that rate cut. And that's a bit of a problem because a lot of people are really expecting it. And so I think the problem that the Fed might face is if they don't cut when the market's expecting them to, this year, whether it's, June or obviously March, they kind of took off the table, but they might have to cut more quickly when they finally do start cutting because something's bad is happening. So I think it's a really tricky time, but I think in the US, it's interesting because institutional portfolios have been flooding into the private markets. There's a lot of volatility in the public markets. It's hard to sit on an investment committee, be a long-term investor and have kind of the volatility. So you can even see the number of public stocks is so much smaller than it used to be. And so I think the problem, we were down in the vault earlier looking at pictures from 1907 from a bank run. And I think the problem is that so much capital has gone into the private markets that there's less money in the public markets and less money coming into that market. And it's a kind of tricky thing to kind of lose control over lending and the extension of credit, because private credit, used to be private equity, now it's private credit, is just expanding so much. So I think it's a really tricky time because inflation expectations are really contained. The Fed has convinced the market that inflation, they've got this, it's not going to be a problem in the future. But I think even when you're looking, to Ellen's point, everybody in the market is looking for those Fed cuts. Expectations are super high that the Fed's going to cut rates. You can see it even in the skew data. And what I mean by that is in the options, interest rate options market, all the skew is to receiving rates, meaning the Fed cutting rates. Payers, nobody cares. Nobody wants to pay the carry. Nobody thinks the Fed's going to be not cutting. And that's kind of scary when the whole market is saying, make with the rate cuts, and the Fed disappoints, and then we could have, really a swoosh market. The data has been great, right? Everybody's been surprised by how good the data is. And I think some people don't even believe the data. The jobs number, like some people are like, all right, whatever, because the Bureau of Labor Statistics, they revise things, right? How many times does it get revised? So, and even things like the inflation data, yeah, you could look at the commodities market because that existed in the 70s and 80s when we last had periods of inflation, but the rates markets, even the TIPS market is new, right? The US Treasury first issued TIPS in 1997. So if you look at break evens, the market's saying, no problem, inflation's going to be around 2% in the future and everything is okay. But I think the bar is really high for the Fed to disappoint because so much is expected in terms of these cuts.
And two things I want to mention of what we see in the small business world and lower middle market world, because of the pressure of higher costs, because of the pressure of tight markets, there's just an interesting dynamics unleashing, right? So one is this change from globalization to regionalization. And so many of these small manufacturers that used to say China's difficult or, all the COVID stops, now they're looking at Mexico, and Mexico is now a bigger partner, trade partner than China. So such interesting opportunities there. We're looking at many of those. And then in the labor market, another trend that we've seen that is really interesting is how so many, especially when I think about, for example, Hispanic business owners, historically, doing business in Mexico and Brazil was sort of two different worlds. And now the dynamics, you go to Colombia, you go to Mexico, you go to Brazil, people are all working for Amazon, for Ernst & Young. And so the middle markets and the small businesses are getting that they can get very high quality labor at half of the cost. And so it's very interesting, these dynamics that are emerging. I think that there's just a tremendous amount of opportunity. And sometimes it's what do we do here? Costs are very high, labor markets are high and tight, and so what do we do? And there's very interesting dynamics unleashing that I think can, create great value. We were looking at a business probably 3 years ago where their cost of labor had their margins be at 15%. They're now at 25, thanks to 80% of their labor now bringing in from Latin America. And there's all these, before there was just like employment, how do you hire there? Where there are all sorts of solutions now out there. And so it's interesting how these trends in regionalization and the dynamics that are being created between the US market and Latin America are going to unleash very interesting things. And we actually, small and middle market businesses followed the big companies, right? A friend of mine is the treasurer of a large consulting firm in Mexico. She was telling me 90% of the work they do is for US, but it's all stationed in Mexico, right? So interesting trends that I think that spell for, opening of markets, interesting accommodations, and regionalization as opposed to globalization.
But I think you make a great point, Monika, because of the strong dollar and interest rate differentials being really tight. If you look at Mexico, Chile, Colombia, Brazil, the interest rate differentials with the policy rate at 5.25 and a strong US dollar, it's really cheap for US companies to go hire foreign labor, right? And at the same time, we've had, as Ellen pointed out, one of the biggest periods of immigration in our country in ages. And so think about that balance sheet kind of with companies in the US hiring services, jobs overseas, not here. And then we have this huge increase in immigration, which is all going to need a place to live. And if you don't already own a house in the property market, it's unaffordable with interest rates where they are. The wealth gap has just exploded higher, and there's a very limited supply. So I think we could see something like what we see in Canada, right? Canada had way less immigration than the US, and their property market just went crazy, right? Hyperinflation because of the shortage of housing. And I think that's one risk that in the labor market data, you don't necessarily see Amazon and all these tech companies. They can hire anywhere. And with a strong dollar, outside the US looks cheap.
A lot of interesting dynamics and a lot of nuances to what's happening in the markets today. Maybe the last topic to just shift gears a bit is really around the fiscal deficits and public debt. So there many anticipate that there is continued uncertainty around the path for monetary policy, record fiscal deficits, and rising domestic and international public debt. So we'd love to get some perspectives on how you anticipate high fiscal deficits and public debt will impact growth and the market resiliency this year. I think, Nancy, would be great if you could provide a perspective from the public markets, and then Monika, a comment from the middle market or private credit perspective.
Yeah, definitely. It's a really interesting dynamic which is going on right now. It's kind of tricky because you have, you want to have credit, you want to continue, but the interest rate policy is so key. And I think, to the point about small businesses and so much capital going into the private markets, is it really different if you're giving a company a loan, right? And you're betting on a good management team, you're betting that they have revenues and hopefully some more revenues than their costs and have some profitability. It's not really that different than the public credit markets. It's sort of, it's not, you don't have the volatility of the daily mark to market, but it's kind of the same thing. And I think what's going on right now is there's been, volatility is incredibly cheap in the public markets, and a lot of capital has been moving into the private credit markets, and it's still really tight. Like, it's very hard to get a loan. It's very hard to, now there is a ton of direct lending going on with companies, right? But it's not getting to people. I almost feel like it's deja vu. I remember in '05 really is when it started. Do you guys remember the spam that you would get in the mail about you're pre-approved for a loan, do you want a loan? That's happening now on the business side. So every day I open up my email, I work for a small business, Quadratic Capital Management, we must be in these databases. I get anywhere from 5 to 12 emails a week saying, would Quadratic Capital Management like a no strings attached business loan? Same thing, just going to a different segment of the market. And so I think it's really tough because we have to, we want to keep the labor market strong. There is a dual mandate. But it's tricky because we do have, it's not just a bubble, right? It is a global economy and the dollar does play into account and the Treasury does have to refinance. I'm still mad at Mnuchin. I worked at Goldman for 10 years. I know this is recorded, but I felt like he should have termed out the debt. Like I wanted to grab him and be like, why didn't you issue long dated debt to lock in when we were in this 0 to negative interest rate yield environment around the world? Bonds that were long duration were just being gobbled up by investors because there's a shortage still of high quality sovereign bonds because a lot of people do asset liability matching. So I think it's a tricky situation right now because we do have high interest rates, given policy rates, a very inverted yield curve still in the US, and we do have a ton of new issuance that's going to come onto the market. And so it's tricky. And the same things that existed with Silicon Valley Bank, those are all still there, right? Nothing has changed. There is a mismatch when a bank buys a government bond, they don't mark it, right? It's not marked to market. And so you always have that risk still in the market. So I'd say it's definitely keep your head on a swivel because I'm not, I think 2024 could be a pretty volatile year because the markets, the volatility markets are so calm. Everything is okay, but is it really?
And my comment on private credit, it's just, growing like crazy, right? Like if there any institutional investor that doesn't have it, they're going to have it. It's in their next investment committee, and so it's growing. It's going to continue to grow. There is a reason from the business side of why it's such a strong solution, right? There's the flexibility, and there's also the value add that a private lender brings. So I do think that it is an asset class that is incredibly resilient, that is here to stay, that will grow, that lends a phenomenal value to the small business. Like one of the things that small business tells us frequently is, yes, you give us patient capital and that's great, but you bring us a whole ecosystem, you bring us a whole management system, helping us with every aspect of financial discipline, operational discipline, human capital. And so that's the promise of private credit, at least in the small business, the lower middle market, where it's patient capital with strategic value, right? And, private credit has all sorts of segments. We're in the segment of small and middle market, but definitely, our analysis we did a couple of years ago with 39 of the largest corporations and a study of what would happen if these businesses really had the ability to have the patient capital they needed, the right capital structure, and the right strategic resources. And the promise, the estimation of value creation was around $600 billion, right? It's a very significant opportunity of value creation. And I think that it's going to continue to grow no matter what. And we're happy about that.
Great. Well, thank you for sharing your perspectives on areas that are on top of mind for all of us, as I'm sure it's going to be another interesting year. Just in the last 5 minutes, could each of you share either one career recommendation for women in finance or one thought on how to improve the position of women in financial markets? Maybe we'll go this way around, Nancy, and start with you.
So I would say I would take a lot of ownership. Everyone in this room is, able to really make a difference. I know when I started at Goldman in the late 90s, I spent the majority of my career on the proprietary desk. I was the only female prop trader. And I had kind of the epiphany to look around and be like, I'm getting more senior, I can change this. And I made an intentional effort to go and recruit people from different socioeconomic backgrounds, people from different universities, people with different genders, people from different backgrounds, just generally. And so I'd say, it's a tremendous opportunity because you can really change and help things get you personally with your hiring, with your recruiting. It's a really tight market too for students. The labor market is kind of split between blue collar, white collar. For kids who are in university right now, I've been teaching at Cornell since 2011. I've never in all that time ever gotten one of these emails, but yesterday I got basically a spam message saying, please help our students get jobs. The job market for kids coming out of college is terrible. So I'd say, it's a great opportunity when you're hiring, when you're thinking about building out your team to really make a difference yourself. And I think that ownership that you all have in this room is huge, and you can really move the needle.
Yeah, so I echo that on the senior side. If you are a senior female in your field, then don't wait for other females to come to you, seek them out, and don't just be a mentor and provide advice in your career experience, be an advocate. So actually make things happen for them. If you are a junior female in your field, seek out those senior female leaders. Seek them out easily. Don't take a lot of their time by saying, I just want to hear about your experience. And then once you have them, though, you have them. And don't leave that conversation without getting 2 names of other people they recommend you should talk to. And that's how you will find the mentor that will become advocate for you.
Great, thank you.
I would say, the purpose of what we do is what has been my driver to do what we do, right? Our purpose as firm is to transform societies through entrepreneurial success. Frequently, women think about beyond them, right? They think about their family, think about community. And sometimes they say, oh, let me go to the nonprofit world, right? Or maybe, the impact world. The work in fixed income and in private credit can be also transforming societies through entrepreneurial success. And so I think that there's a combination of, being fiduciaries, delivering above market returns, but also changing the world. There's nothing more rewarding than sitting with an entrepreneur, understanding their view, helping them to double, triple their size, creating high quality jobs around it. And so for me, that combination of, having the responsibility and the joy of being a fiduciary, while at the same time being able to help entrepreneurs and then see it in numbers, right? Number of employees, revenue growing, EBITDA growing. It's fascinating. It's a phenomenal combination of financial performance and delivering impact in society. So I think that the space we're in, that is private credit, but it's also impact private credit. I think that for those of you that have friends, if you're here, it's because you like fixed income, right? So we don't need to preach to you, but why other women when I think that if you're thinking about the nonprofit world, you're thinking about purpose in your life, fixed income is a place where you can deliver purpose and financial returns.
Thank you, Monika.
I can't add very much because I'm not in the world of fixed income, but I wanted to emphasize what Ellen said, and all my colleagues here have said, that is valid for all women that want to make a career and have an impact. Seek out for mentors. Don't expect that the mentors come to you all the time. Be proactive. Engage in a number of, an interrelation with your peers and with your adult. Otherwise, that's the way you make step forward in any world, the finance or economics.
Great. Thank you very much, everyone. And thank you. Thanks.
We're all like thirsty.
Good afternoon, everyone, and just what an amazing event and an amazing audience. And I really have to start, first of all, with just a huge thank you to everybody at the New York Fed who has welcomed us here, from everything from the Gold Vault through the wonderful museum. And I want to really just thank the senior leaders, Michelle, Julie, Argios, and Anna here, but also a special shout out to Kayla and Maylene for all of the work they've done in marshaling this through, and the men as allies, because it was Connor and Mike who really took it on board when I said, we'd love to partner with you and really bring the whole community together. So, as Monika mentioned, we started this conference back in 2015, and it was a dinner with a handful of us around a table. And it was still a pretty small event, but then during the pandemic, when we were all isolated and at home, we put this out virtually, and we had 1,000 people, sort of call in, and everybody said, look, I'm the only woman in fixed income, and I'm isolated right now. And so to be able to turn this into something where we have 350 people in person, 300 online, replays that will be available, and to host it here at the Fed, because what all women in fixed income are Fed watchers. And to just have also just the wonderful staff here give us the tours, share the history, and to be in this building. So thank you to everybody at the New York Fed, and a huge thank you to Lauren for all of the coordination with everybody here at the Fed. Well, what an amazing set of panels that we've had so far. So I'm, I think all of you know, I'm Joyce Chang. I'm Chair of Global Research at JP Morgan on the board of FIASI. And I want to just say that, when I take a look at what we've seen over the last year, we've seen hikes, a pause, and a pivot, all in 1 year. And let's just take a look at what we've seen during the month of January, because we've seen some new records set. We've broken, we're talking about fixed income, but we've broken the record for the S&P 500. If you look at January issuance across high grade, high yield, and the leveraged loan market, it hit an all-time record, $361 billion, actually exceeding when the market reopened, in 2020 after the pandemic. And if we look at fund flows that have gone into the credit markets, they're running at 2.5 times the pace of what we've seen on average over the last 5 years. So as we heard, this is a market that is on fire now, and it's kind of worrisome. Is this sustainable? Because financial conditions, which we thought would be headwinds, they're now a tailwind for growth. And what does this mean going forward? So I have to just share a few of JP Morgan's views before I introduce this amazing panel. I'm kind of with Ellen. I don't think it's a recession this year, but we think it's 50-50 for 2025. And we also have the first Fed ease in the month of June, looking at a lot of the same issues, how tight the labor markets are right now, that there's a lot of interest in private credit, but there's actually perhaps not enough questions that are being asked, in my view, and there's this stretch for yield. So we've got so much to talk about today. So I'm very pleased to have on this panel, and let me just introduce them in the order that they're sitting. Anna Nordstrom, who is the head of domestic and international market functions in the markets group at the Federal Reserve Bank of New York here. Susanna Gibbons, who is a former investment advisory counsel for the Minnesota State Board of Investment and managing director of the David Kidwell Funds Enterprise at the Carlson School of Management at the University of Minnesota. Paloma San Valentin, who is the head of the corporate finance group for North America at Moody's Investor Service, and Milas Gunkina, who is the senior managing director, the lead portfolio manager for emerging markets at Lord Abbett. So we're going to talk about the domestic issues, but also get into some of the international issues as well. So Anna, thank you so much for hosting this and also for being part of this panel. So we heard from Michelle and Julia earlier about the unique role that the New York Fed plays within the Federal Reserve System, and in particular, the role of the markets group in implementing the FOMC policy derivatives. So before we discuss some of the specific themes that we're going to go through in the fixed income market for the year ahead, Anna, could you provide an overview of the markets groups, how you monitor the fixed income markets, what you look at. I mean, last year we heard about some of the indexes that had been created, how your work supports market functioning. And also, like, as we've looked at this tremendous market rally, what are the risks that you're really marketing with respect to market function this year? Thank you, Anna.
Thank you. Thank you very much, Joyce. I have to admit, I got a little bit nervous there when you said we're all here Fed watchers. So I'm glad Julie gave the keynote speech, what is really the important stuff. Anyway, so before I start, I just want to say that what I will say here today are, of course, my own views and do not necessarily reflect the Federal Reserve Bank of New York or the Federal Reserve System. So with that, I begin. So the domestic and international markets function form part of the open market trading desk at the New York Fed. And it is an honor to serve here, I have to say. So we are responsible for implementing monetary policy operations, for conducting foreign currency operations, and for analyzing the markets associated with our policy implementation. So I would say that this is really where the team on the desk actually make it happen. They implement the FOMC's directives. So I just want to say that another area where we interact deeply in markets is, of course, in the function where we issue the Treasury debt as part of our responsibility as a fiscal agent for the US Treasury and support their debt management. So what does it mean in terms of how we engage in markets? We are deeply, deeply engaged in markets on a daily basis. And I want to call out 3 areas. And one is really, the core implementation of monetary policy operations. Here, we implement daily the directive of the FOMC to ensure that the target range, that Fed funds remain in the target range, and the FOMC achieves a dual mandate. Our team on the desk, for example, they run the overnight reverse repo facility that Julie discussed in her speech and that Michelle also mentioned in her welcoming remarks. And this is really an important facility to ensure and form part of the floor for our rates. The team also managed the standing repo facility, which is really important to serve as a facility that limiting any potential upward moments in the pressures in the repo market. So, and then of course, during the time of when we use the asset side of the balance sheet, as Julie discussed in her speech, the team on the desk is very active in asset purchases. So it really depends a little bit on, like the spread of our implementation depends on the policy at the time. I think this leads me really to also what the team is doing on a daily basis as part of that, really deeply engaged with market participants to discuss market developments. So this forms the intelligence and really the daily intelligence to ensure that our operations are implemented efficiently, gather information and understanding of markets to help design our implementation operations, and also to identify stresses in the market, and then see if there is any need to respond and to support policymakers in those deliberations. And so the intelligence that informs also the basis for our analysis, the broader financial conditions analysis, which is very, very important. And here we interact with a broad range of market participants. Of course, we are very deeply involved in the core, what we would say core to our policy implementation framework, treasury market, domestic money markets, MBS markets. But we also engage broadly with financial markets. And just one example, of course, is internationally, the offshore dollar funding markets are very significant, and stresses there can transmit into domestic funding markets. So that is also then important for our overall financial assessment. So this helps form the background and really for our SOMA manager, Roberto Parli, to deliver his assessment to the FOMC, where Julie also attends and supports that delivery. So just finally on that more structured engagement is happening through our Treasury Markets Practices Group and the Interagency Working Group that we sit on together with the board, with the SEC, CFTC, and the US Treasury. And just very briefly before I stop, if we look ahead, what are we focused ahead? We are focused on many things as central bankers, always. However, since this is a fixed income event, I do want to call out, we are very focused currently on the treasury market in terms of the implementation of the SEC's final rule to significantly expand the central clearing transactions. And this shift, of course, is a very important development in the fixed income markets. And it's an important step towards reducing risks and increasing the resiliency in treasury markets, which has been a very important priority for the interagency working group. So we're monitoring this timeline, how this evolves, and also helping understand whether the market is ready for this, is also preparing early enough to ensure that, that we have a smooth implementation.
That has been top of mind for all of us in fixed income. So we're going to come back to the treasury market a bit later, but we're going to move on to credit now, to Susanna and Paloma. So, we have seen this just massive rally in the markets, record issuance. And Susanna, I want to just ask you how you're really looking at relative value now. I'm asked, look, there's just no spread. I mean, as Nancy mentioned, in the investment grade market, should I really be moving into high yield, less liquid, instruments? So how do you think about relative value, and the composition of the credit portfolio you should hold when we're at such tight spreads? And, and one thing we haven't talked about yet is CLOs. Does that make more sense in this type of environment? What's the optimal portfolio now, given the current market conditions?
Thanks, Joyce. And thank you to FIASI and the New York Fed for the invitation to be here. I also have to say that I am speaking on behalf of myself. My opinions are my own and not the University of Minnesota, nor do I represent the Minnesota State Board of Investments. And you'll see why that's important. So not only are fixed income people, all Fed watchers, but we are all armchair economists. So my apologies to the actual economists in the room. I'm going to take everything that you've said and squish it into sort of my own frame of reference. And that's kind of what you have to do as a portfolio manager, right? You've got to figure out the environment in which you are operating. And unlike Ellen, I have never been known as a Pollyanna. In fact, I recall coming back from a client meeting at one point, and my colleagues had replaced my name badge with a sign that said Ms. D&G, which they said stood for doom and gloom. I thought it was Dolce & Gabbana, but it's, and so I find myself now in the very uncomfortable position of having to agree with a Pollyanna. And I don't like it, but nevertheless, I think that's the backdrop that we are faced with. For this year, and I'll come back to that in a second, because part of the backdrop is the recession question. I think for this year, in spite of hundreds of basis points of very rapid rate hikes, and a deeply inverted yield curve for well over a year now, the economy has been just shockingly resilient. And so I think the best play for 2024 is we have to continue to invest in that environment. And I think back to the recession question, I actually think that is the wrong question. What we are waiting for as a result of all of these rate hikes is not the recession. We're waiting for the financial accident. And the financial accident is usually what then leads to the recession. So we're waiting for the financial accident, and it's not coming. And I've been thinking to myself, well, where the hell is it? And usually you look to the leverage trade. Where has the rise in short-term rates, where has it squeezed somebody out? And I think the leverage trade is stuck firmly inside private markets. I'm like, that is brilliant, because they're stuck. They can't unwind their trade. And so systemic risk is not going to materialize in the same way. So that's my backdrop. Like there'll be a recession, but if we get a recession, credit will still perform reasonably well as we go through the recession. So the most important thing is that I am not positioning for the financial accident. However, following Nancy's comments, and this is going to be the quote of the day, spreads are on fire. Right? it makes it very difficult for me to get sort of bulled up on anything. I mean, spreads on the investment grade side are at pretty tight levels. High yield, I think, is even tighter. So you've got this terrific fundamental backdrop, but everybody knows it, and everybody's sort of fully invested. We did have, huge fund flows into fixed income. Mostly came out of equities, recognizing, that we ended 2023 on this really high note. So we were, because of the huge inflows, we were able to absorb, pretty significant, probably record supply for the month of January. So where are the pockets? So there may be a little bit of a pocket within bank credit, but I'm not a huge fan of bank credit. In part, we had, another reminder last week, as the previous panel pointed out. But also we've got the Basel III endgame staring us in the face. And so I'm uncomfortable with where banks are, and you're only picking up maybe 20 or 25 to go into banks. And so that could be a little pocket of opportunity. I'm not crazy about it. If you're gonna go into banks, I think you wanna be really careful and selective in terms of underwriting it. And I'll just give a little plug for JP Morgan, happens to probably be one of my favorite banks. So it's it was actually my first employer, so. So I think this is a year where you basically have to try to put money to work, tread water, and wait for opportunity. And so I think it's an up in quality kind of year, and it is a carry year. You may have a little bit of, maybe 20 basis points or so of spread tightening in IG, but that's not really what I would bank on, right? I think it's like an up in quality year. And so looking for other pockets in structured product, so even like credit card deals. And I know the other panel was talking about going into short paper. I'm like, well, 3 or 5 year credit card deals actually look pretty good to me compared to 3 or 5 year Apple. And so that's a pocket where you can kind of hang out. It's not gonna, you're not gonna have a fantastic year, but I think it's a pretty safe pocket. AAA tranches of CLOs, as much as I hate some of the credit that has gone into CLOs, you've got so much, so much subordination and so much spread on those deals. I think AAA tranches of CLOs probably make some sense. So basically, it's a carry year. Look for little pockets of opportunity. You might see some in taxable munis, for example. So giving up a little bit of liquidity and looking for taxable munis probably 5 years and in. So it's pockets of opportunity, treading water, trying to gather carry for most of the year.
Well, thank you so much for that, Susanna, for really giving us some sort of tangible recommendations that are separate from a lot of the plain vanilla. Now, a lot of people have asked me, like, gee, Joyce, what do you like right now? So I said, actually, we're structurally bullish on gold. And it was great to visit the gold vault right before this panel. Only custodian here is New York Fed of gold, but gold is one of the ones that we like. But I'm going to keep on going with credit. So Paloma, let me come to you. In listening to your podcast, you've also pointed out that the landscape for companies is uneven across the globe, and we've already talked about the tight spreads here in the US. So last year, the focus was on higher for longer interest rates, raising the cost of borrowing and refinancing. And we saw that a lot of the leveraged finance deals struggled, in this environment. But since the beginning of the year, we've seen this really easing of financial conditions, with the, an uptick in borrowing, and corporate issuance. So how do you characterize the credit outlook for corporates in the current environment, particularly in the US? And how are you taking a look at just sort of, should you be up in quality, looking at higher yield? And how are you looking at default rates here?
Okay, so thank you, Joyce, for the question. There's a lot to unpack on that. So I'm going to try to do my best and not be overly wordy about it. And it feels a little awkward to be here at the Fed and be talking about what the Fed might or might not do. But I think it is important to explain our baseline. And I'm speaking for Moody's, what we're seeing ahead. We do expect the Fed to cut rates this year, starting in the second quarter. And probably for about 100 basis points in total again this year. We also expect the economy to grow by about 1%. Now, looking back, 2.5% in 2023, that's still pretty low growth ahead, and probably a similar amount next year. Now, despite the higher for longer interest rates and the possible negative impact on that, and despite the slower growth ahead, the relative strength of the US economy and the fact that for now we have avoided a recession, they clearly underpin our stable outlook for non-financial corporates in North America. We have seen relatively robust corporate profits. We've seen inflation abating. We've seen a very solid labor market. We've seen very firm consumer spending, getting more selective and probably losing a little bit of the wind in their sails, but still pretty strong. And companies have been able to adapt to the changing conditions. We've also seen plenty of resilience in investment-grade territory. And looking at the industry level, we follow about 17 industry sectors globally, and we also have outlooks for them. The mix in those outlooks is also signaling more stability. We have 10 industries on stable outlook. We have 3 on positive and 4 in negative. And those 4 include autos, diversified manufacturing, paper and forest products, and real estate. A year ago, I would have been saying that we had twice as many negative outlooks, industry outlooks, than stable. Now, higher interest rates are naturally putting more pressure on certain subsectors of the economy. We've spoken about commercial real estate or capital goods manufacturing, or perhaps consumer durables. But regardless of sector, we're generally more concerned at the low end of the rating scale, right? That's where most of the weak structures and weaker credits live. That's where we see the highest refinancing costs, the lowest access to market, and the liquidity pressures. And that's where we have been seeing the most defaults in 2023, as would be natural, and still a lot of stress in 2024. So that is our big pocket of risk. Now, this is the baseline, but of course, plenty of risks to the downside. I think somebody in the previous panel mentioned geopolitical uncertainty. The other one that's clear this year that's a little different is political polarization. It's a globally heavy election year, and all of that can certainly affect confidence and sentiment, and confidence and sentiment are drivers of credit conditions. So we have a pretty complex environment to watch. Why are we more concerned at the low end of the rating scale, so the spec grade universe? That makes up about 2/3 of our rated portfolio. Yeah. And the majority of that portfolio is actually rated B2 and below. So that's relatively weak on our scale. Mostly PE-owned companies and mostly loan-only structures. So looking ahead, what do we see? We see more refinancing risk. Spec grades rated companies are facing $1.3 trillion of loan maturities and $600 billion of bond maturities over the next 5 years, so 2024 to 2028. And about 40% of those bond maturities are in the hands of companies that are rated B3 or below. So again, the risks are there. And even if market conditions today are certainly much more supportive than they've been in quite a while, these debt maturities, these towers, are pretty tall, and the companies that are facing them are still pretty weak from a credit standpoint. So any bout of uncertainty or volatility could actually undermine their capacity to refinance. And there's also some concentration at the low end of the scale in certain sectors like services, consumer products, healthcare, and technology. Talking about the defaults for a moment, in 2023, we recorded at around 100. That's 3 times as many as we recorded in 2022, and 2/3 of the 100 are distressed exchanges. So, looking forward, if the default rates for the US ended the year at around 5.6%, We expect it to peak around 5.8% or so, probably around right about now, and decrease throughout the year to around 4%. Not the 2% or the 1% of years past when all things were, were much more favorable. And there is a common theme here. So higher rates, higher interest rates for longer, but also higher default rates for longer.
No, thank you so much, Paloma. So, we're hearing up in quality, and that, there are downside risks that may take longer to play out in this environment, that they shouldn't be ignored. So, Neal, I want to come to the international markets now. So we've heard about just the difficulty in finding value here in the U.S. We heard about this regionalization trend and, more interest in Latin America right now. But it's been a tough road for emerging markets. I mean, really big outflows in 2022 and 2023, despite emerging markets having, actually the big emerging markets keeping pretty responsible macro policy. So I just wanted to ask you to talk about, what your expectations are from emerging markets this year, where you see value when you look across credit, FX markets, rates markets, and how you factor in what the Fed is doing into the implications it will have for emerging markets. Are there certain bright spots that you'd like to highlight in all of this, and how you think about geopolitical risk?
Yeah, okay, great. Well, thank you so much, Joyce, for that question. Thank you for the invitation to be here. It's very nice to be here with you all this afternoon. So to answer your question, the way that I think about emerging markets outlook for 2024, I would frame it across sort of three main pillars, right? So the first one is the global growth and the global monetary policy. The second one would be what are the actual fundamentals look like for the credit and the sovereigns that we look at. And of course, three that's talked about here a lot on the panels is valuation vis-a-vis what are the other opportunities across global asset classes. So on the macro, I'm going to, and by the way, I'm just going to give the answer away to spare you the wait for this talk, is I'm pretty positive on emerging markets in 2024. I see it as a good pocket of opportunity as we look across credit markets. So on macro, I think that, U.S. growth, global growth is actually doing okay. The U.S. is still resilient. We'll talk about China later, but China is still continuing to deliver, close to 5% growth, which is second largest economy. That's pretty important. And other emerging markets across the world are doing actually quite well. So we've mentioned Latin America, but also, of course, parts of Asia, parts of sub-Saharan Africa. They're doing pretty good. And what's important for emerging market asset classes, of course, the growth differential, which in 2022 and 23 were quite challenged because the U.S. was so strong. And I think that's partially why we saw the outflows. But in 24, I see that returning in favor of emerging markets. And on the central bank policy, of course, it's a very important macro driver for the asset class. And, maybe I'll start here with EM, which is not typical because typically emerging market central banks, they follow the Fed. But in this particular post-COVID cycle, emerging markets have actually been in front of the Fed, and they were hiking sort of well in advance of the Fed's first hike. And because they saw inflation sort of coming and they couldn't sort of afford to wait. And now what we're facing in 2024 is a potential for a pretty synchronized easing cycle across the world. EM central banks are already well into the cutting cycles. We expect some Asian countries to join later in the year. And I think, for the Fed, there is a lot of debate around, is it going to be, of course, perhaps not March? Is it May? Is it June? I don't know. But the point is that to me, it's pretty clear that we're in a regime change from restrictive monetary policy to not restrictive monetary policy. And that's a pretty big change for us, and again, supportive for the asset class. On the fundamentals, what I'll briefly mention is that, if I look at emerging markets asset class, it's pretty well diversified across investment grade, high yield, across regions, across countries, across political regimes and economic models. And so, maybe 20 years ago, we could talk about, okay, there was a contagion, as it relates to Fed raising rates, for example, or other potential issues, geopolitics come up. I think that, over the last 2 decades, large emerging markets have really sort of learned their lessons and have shown to us pretty credible monetary policy, pretty credible fiscal policy in the face of crisis after crisis of COVID, then the war, then the inflation. And so this diversification, I think, provides, the diversification argument for emerging market asset class, I think, is back. And look, on valuations, I think, yes, investment grade seems quite tight in the US. I think that EM investment grade offers some interesting opportunities, especially as it relates to the long end of the curve, as that we see the curves in investment grade in EM are actually much steeper than the US counterparts. I see good opportunities in high yield as it relates to sovereigns and corporates around the world. There is very interesting uncorrelated opportunities in distressed and stressed parts of the universe as well. So there's a lot of interesting things to do, and I think geopolitics keep coming up over and over again. And what I would say is that for an active asset manager who is interested in emerging markets, it's actually really good because then you can differentiate between what you want to put in your portfolio.
Thank you so much, Mila. So a case for diversification, particularly when we have such stretched valuations in the U.S. So Anna, I want to come back to you on the Treasury market because we heard a lot about just sort of the tailwinds on financial conditions, but we've also seen just record fiscal deficits, which are translating into expectations for greater net U.S. Treasury issuance this year. And Nancy's point that why didn't Mnuchin sort of take advantage and term out the debt? So you mentioned and talked about how your group analyzes the Treasury market. Given the backdrop of greater supply and the potential for more elevated volatility, how does the market group monitor the Treasury market functioning and demand and liquidity?
Thanks, very important topic. So maybe just first a few words on how we monitor treasury markets, functioning liquidity, and then maybe some practical examples of the contributions that our teams on the desk provide in terms of outcomes from that monitoring. So first, we analyze many facets of fixed income markets. And that includes analyzing deeply when we have events, like liquidity events. And for example, we learned a great deal from the market dysfunction event of the pandemic outbreak in 2020. So to understand market functioning, and we look at liquidity, both in terms of funding and market liquidity and efficient pricing as two important characteristics. But of course, I think all here agree that it's not enough to stop there. So it's really not one indicator, so it's really looking across a set of indicators, so direct measures of liquidity, measures of relative value, indirect measures that includes analysis of the operations that we conduct in the market. That help to serve a very helpful information for us in terms of understanding and see different dynamics evolving. And then, of course, to your point about supply, we look at measures of the balance between volumes of sales and purchases in the market. But I think we layer on top of that, we need to understand, we need to discuss with market participants and the broad-based investors and different types internationally as well as domestically in terms of what are the drivers and motivations for their participation in the treasury market. So how should we actually interpret these indicators and what they're telling us? And I would say this is really important. The treasury market is key for transmission of monetary policy. It also serves as a bedrock for the global financial system in terms of setting prices throughout the world. So immensely important market to us. And just maybe an example here of how the desk's staff team contribute to implementation and design of implementation. So through the team's involvement and what they learn from markets, they can also provide them feedback into our policymakers to inform of markets dysfunction. And one example here again was the Dash for Cash that created some dysfunction in the treasury market in 2020. And here the design of the FEMA repo facility that is for official sector counterparties where they can fund their treasuries in periods of stress in the market, and as such, they don't have to sell into a liquid market. So that's an example of the interaction through the activities of our desk staff in terms of understanding markets and feeding back into the policy process. And of course, we also expanded swap lines during that time in terms of trying to manage potential transmission from offshore dollar funding markets. Now, just a few words on ahead. So, I mean, I think we've seen a smooth functioning of the treasury market so far. And this is happening against the backdrop of increased interest rate volatility that we have observed in the last year. So Julie spoke about the runoff of our asset portfolio, and it's been sizable, as Julie mentioned, about 1.1 trillion in treasury runoff. We have seen during this period that market participants have not cited balance sheet issues so far, or that this has impacted market functioning. And generally, from what we see is that market liquidity have been in line pretty much with historical measures of interest rate volatility. I mean, it is true that treasury issuance is increasing and it has increased in recent years. And this is where we look at conditions in terms of demand and supply in the treasury market. But we do see, of course, here, we have a very diverse investor base in the US treasury market. And we do see how this diverse investor base respond to the different developments, both in terms of money market funds and how they responded for demand for treasury bills. We see foreign interest is very robust. It speaks to the characteristics of treasuries in a diverse portfolio. And our analysis so far has not seen that the value proposition of that role that treasuries form in a diverse portfolio has changed. So something we monitor. But so far, we have not seen fundamental changes there.
No, thank you so much, Anna. And I want to now turn to Susanna and really bring in the whole topic of ESG, because this is one where there's just a growing debate around ESG right now, backlash on strategies that incorporate ESG from some states. Mm-hmm. We have seen broader concerns about market performance versus traditional benchmarks, and concerns about greenwashing as well. So how are you seeing the outlook for ESG investing? And what do you see as the key risks to growth to the sector?
Yeah, so the first issue will be the political, right, which you mentioned, the anti-ESG legislation, which started to get introduced a couple of years ago. Most states have not actually adopted the legislation, but that legislation basically says you can't look at ESG. Okay, maybe if there's an economic effect, but you can't look at ESG. At this point, there are many, many states that have now started to put out pro-ESG legislation. It's still early in this legislative cycle on a state-by-state basis, but I think you are going to see pro-ESG legislation come to the table. Most of the pro-ESG legislation acknowledges that as a fiduciary, you have an obligation to incorporate ESG to the extent that it presents material economic impacts. So I think the anti-ESG legislation really is, it's gone a little bit under the radar, but it's kind of a shocking attempt to rewrite the laws of fiduciary responsibility and fiduciary duty. And so I think the pro-ESG legislation is sort of pushing back on that, and we'll see where that goes this session. So the second question is, well, are the economic impacts real? And I think we're very clearly seeing, not just in other parts of the world where you might expect it, but also in the United States, the economic impacts are real. The Inflation Reduction Act is allocating trillions of dollars to projects that will basically help us usher in the climate transition. The state of Minnesota by 2040 will be carbon zero in its electric grid. And the electric utilities have already mapped out, you can see where the plant retirements are and the plants that have come in. So, and we're not the only state that is in that position. It's not just blue states, but red states. The state of Montana right now is closing down a 3,000 megawatt coal-fired plant and replacing it with a massive, massive underground essentially battery storage system, which they will use to wheel power to the state of California. So the transition is real, the economic impacts are real, and we haven't talked about sort of the credit implications, but it's going to have very, very different impacts on the companies that we look at. So I think as a responsible investor, you have to be incorporating this incredible secular shift that is going on right now.
So it is a big secular shift. So just how do we deal with that as investors? So I want to come to Paloma and Neal, and I'm looking at the
time, I know.
I'm looking at the time, so I'm going to ask for the quickest answers possible for the biggest questions. So I'm sorry about that. But Paloma, just your take on private credit right now from Moody's perspective. Like, how do you see this evolving? What are your perspectives and what are your concerns in this space?
So private credit is not new, but it has had tremendous momentum certainly in 2023, if not 2022 as well. So we agree that it is big, that it is growing, and that it's here to stay. Some market participants estimate that it will grow to about $2.7 trillion by 2027. Some others are saying $3 trillion worth of it by 2028. And part of the growth has been on the back of private equity sponsors that have preferred to work with private credit lenders and have fueled that rapid market expansion. Now there's a lot of dry powder. It's still in the hands of private equity sponsors. So probably a lot of the growth is also going to come from there. And although traditionally we associate private credit with lower credit quality, small, medium-sized companies, we've actually seen private credit starting to move up the credit spectrum, and also start engaging in other areas such as asset-backed lending, which is again another very big pocket of addressable market. So we're seeing the big getting bigger. And many are teaming up with insurance companies, joint ventures or acquisitions. Some of them are looking at private wealth as another pocket of capital. But private credit remains still pretty opaque, and it hasn't really been through a full credit cycle just yet. So asset quality performance could be tested in a year such as this one, where the economy is slowing down, and we've all commented on the potential risks to that. It's true that private credit has acted as a liquidity valve for some of the corporate credits that could not have access to the public markets. And we think it's going to get more competitive as LBOs come back, because the preference of stronger credits will still be to access the public markets where they can get the cheaper pricing and the more flexible documentation. But the banks will want to regain some of the market share that they have lost over the last year or so.
Thank you so much, Paloma. And Neal, I'm sorry, a big question, second largest economy in the world, China. You mentioned 5% growth, but how are you looking at this medium, longer term, just very quickly?
Yeah, of course. So China has been tough from an investment perspective from both credit and equity, and partially because of the transition of the economy that the regulators are trying to engineer away from the real estate and property sector and infrastructure spend and more towards more sustainable but slower growth consumption spending. And so that transition is difficult because one, real estate covers about 20 to 25% of GDP. So while there are bright spots like autos, EVs, for example, decarbonization industries, et cetera, that switch is going to take some time, and it's not going to be even. That's one. Two, the consumption in China has been about 40% of GDP. US is about 70, so that's a very large gap, and that's going to take some time. And regulatory uncertainty just really doesn't help investor sentiment, nor the sentiment, the consumer sentiment inside China. And so to the question of how do we think about the transmission mechanism to the rest of the world, I think that there is enough regulatory power now in terms of fiscal and monetary sort of room to help manage that 4.5% to 5%. But in terms of sort of commodities, we have other demands outside of China real estate, like decarbonization, for example, and emerging markets have come up with other ways to grow. And one of the important points that have been mentioned in the previous panel is basically the supply chain reorientation driven partially by geopolitics. But we have very specific sort of winners in this equation: Latin America, Mexico, India, Vietnam. So there's repositioning of investor FDI, business interest, a little bit away from China into other parts of the emerging markets. 22 seconds.
Okay, thank you so much. Thank you so much, Noah. So I'm going to ask, because I have so many decades of wisdom here, for each of our panelists to share a sentence, so that we try to stay on time on just, their top career recommendation for women in finance. So we heard about the importance of finding an advocate and a sponsor, but just your top recommendation, Anne.
It would be look out for opportunities and be ready to take risks. I think I've learned the most when I've took a bit of a risk going into a job or a work assignment where I didn't quite feel confident that I had the full background, but I learned a lot and grew so much from that.
Great advice, to take risk.
If you think a door has been closed to you, don't worry about it, because something else fantastic will probably open up. Some of the best opportunities I have had were unintended and unplanned and, in a sense, forced on me by one thing closing down. So there's always something else that's ready to open up.
Paloma, over to you.
Yeah, invest in other people's success, be generous with your time, and also be mindful that the power of diversity is nothing without inclusion.
I would say be very creative about your mentorship. Don't just look up, look within your network, look to the side, look to more junior people as well, because there's so much to learn. So don't focus on just kind of like looking up. And the other thing I would say, just be very clear about what your goals are and be your own self-assessor. It's like a dispassionate self-assessor, and sort of realize that feedback loop yourself.
No, thank you all so much, because this is a perfect segue into our final session, which will really address the whole diversity and inclusion issue. But just thank you so much. I mean, so many shared interests in this audience. Research excellence, transparency in markets. So, and let me now welcome the next panel to the stage.
No problem. Do you want to sit on the right or the left? That's fine. I'm supposed to get. No, they're not paying attention. I don't understand what this. Can you even tap the mic? Can we get started? Hey, folks, can we get started, please? We promise we'll let you go.
Just I know, what is this counting down? Us. Because I know we're already 10 minutes late.
Yeah.
Should we cut? I want to make sure that folks get out on time.
Yeah, let's cut 3 and 4.
So this is the right countdown. Okay. Great. Hello, I'm Kate Murtaugh. I am the Chief Compliance Officer and Managing Director for Sustainable Investment at Harvard Management Company, and we look after the Harvard University Endowment. So you may be wondering, why am I here? I also have the pleasure of being the chair of the board of IDIF. So that means Mona Lisa is my boss.
Vice versa.
Yeah. And so I want to actually introduce Mona Lisa Como, who is the Executive Director of IDIF, which is the Institute for Diversity and Inclusion in Finance. And I also want to thank you all for being here and thank to our sponsors for having this event. So we're very excited to be here. So we'll jump right in. Yeah. So Mona Lisa, can you start by telling our audience about the Institute for Diversity and Inclusion in Finance, our mission, and our key initiatives?
Yeah, so first want to also reiterate our gratitude to FIASI for this opportunity, a special call out for Michael Nelson for making this introduction, for Kate and I in making this happen. IDIF was born a few years ago, probably about almost 4 years ago, during the time of strife in the United States during the George COVID days. And the community came together of industry leaders and said, what can we do to make an impact, knowing that there's so many things going on in this space around diversity and inclusion. And what our founding members and board member, a cohort of individuals that came together every week to talk about what they could do, is they figured that the industry itself had enough diversity and inclusion efforts, whether it was vertically focused by institutions or whether it was at the aggregate focused on allocators or asset management. But what it lacked was a connective tissue amongst the industry. And all movements require organization, and it requires somebody hovering at the macro level to make sure that the industry is actually moving forward. And from that was born IDIF, the Institute for Diversity and Inclusion in Finance. We are a nonprofit organization that is not a member-owned, it is not a member-joined. It is a true community, an open forum, where we invite individuals to come and talk specifically in financial services about DEI, because we know that social change in and of itself requires an open forum, a town hall where people can challenge the ideals, talk about things that make them uncomfortable, and be in a space where they can learn from one another, and that's what IDIF is. So we do two things in our mission. We amplify, and that's by making sure that all of the messages that happen, either it's something at FIASI or in other women-led groups or diversity groups, we bring them together and amplify them for the financial services community. And then secondly, we also do a lot of education, and that's whether it's our monthly convenings or we bring cohorts together to talk about burgeoning topics, whether it's how to increase diverse managers in this space or how to ensure that more allocators are looking at more diversity-led organizations. Those are the themes that we focus on, and we bring the community together.
Wonderful. Now, how much of U.S., I know the answer to this question, but I'll ask it anyway. How much of U.S.-based assets are managed by firms owned by people of color or women?
Yeah, and women-led, yeah. So this was, so about in 2021, the Knight Foundation, and I'm pretty certain most of you already know this data, but it is the catalyst of what has really fueled the industry in the last few years. The Knight Foundation did a research based on how much in the asset management industry is managed by diverse populations, which is women or minorities. And what they found is of the $82 trillion in the industry in 2021, only 1.4% of that money was managed by either women or diverse individuals. You break that down even further. Of the 82 trillion, you've got 74 trillion in mutual funds, 5 trillion in private equity, another 1.4 trillion in real estate, and then the delta of that is under $1 trillion specifically in hedge funds. And when you further stratify that and looked even further, I was looking at a data for fixed income mutual funds, but mutual funds, which owns the bulk of the asset management industry, of that, only 0.6% are managed by women. Now think about that data, given the fact that we have so many bright individuals in this room, yet the mutual fund industry owns a tremendous amount of that. And I'm not picking on them, it's just because they are the behemoth. But then when you go into private equity, it's a little bit better, right? We get into a little north of 2-3% for women and minorities. What that shows you is that the opportunity for growth in this space needs to continue. What we do know from the data, though, is that where we've been the 10 years prior is we were under 1%, and now we're at 1.4. The goal is to make tremendous strides, and that's what IDIF is working with the financial ecosystem, is everybody has to do their part to actually see tremendous gains in this space.
Now, what do you think are the best ways to build coalitions, and what strategies are most effective for achieving scale?
Yeah, so coalitions, I think it comes back down to the most basic, and that's organization. This effort does require knowing people, and that's why IDIF, again, was born, because too many people were, whether they were Googling or they were looking up DEI, and then they got articles that weren't really helpful, or they went here or there, everywhere. Organization is key, and so what we try to do is make sure that we can connect you, and if you find people within your space that are also working on these efforts for coalition, especially around DEI, that's really critical. The other thing is education. There is a lot of data and research out there that has been built by, whether it's women-led research groups, institutions like Harvard and Princeton that has the Catalyst. There's so much data out there, but finding a place to actually, and finding consistent data is the challenge. So organization is key, making connections, and then amplification through education is also pretty important.
Now, as was mentioned on the last panel, discussions of ESG investment strategies often lead to discussions regarding the correlation of DEI initiatives and financial returns. When you hear opposition to ESG, what costs or consequences are cited besides financial returns?
So I hear this every day. So I don't come from the nonprofit space. I'm actually a fintech executive licensed. I came from the industry, much like you. And so understand inherently the need for financial returns must drive decision-making. And so what the basic, the number one argument I hear against the DEI or the ESG is that this is a social thing, right? If it feels socially good, but I owe things to my investors, and it's the requirement to be really focused on financial returns. And where I come from is from just the core basic of where we are in this industry, and we heard diversification as a term used. We were using that term way before it was cool. And yet somehow that has now transcended into the importance of diversity in general. If diversification is so critical for hedging risk, for making sure that you can find more innovation, how then is that not applied to the people and the skill sets, as opposed to being solely focused on just the organizations? And so where I push back on that, those ideals, is really focusing on diversification exists right now as a primary investment strategy. If you stuck with that from a financial services, how could you not want to be focused on DEI? Second thing, everything takes time to bake. There isn't anything that you flip on a switch and tomorrow you're going to see an upward hockey stick that is measured immediately. And so patience in making sure that we are measuring things the right way. And then the last thing is maybe we have the wrong measurement stick. And so what can we do as an industry and an organization to actually make sure we're measuring the right thing?
So what are some specific actions that all the folks in this room can take to help advance the mission of IDIF?
Yeah, so there was a lot of great in the other panels when each of the women gave some great ideas on how to further and ideals for women and kind of sticking in the industry. There are a couple of things that we come from that because we have the fortune of looking at things from a thought leadership perspective and also analyzing organizations. Number one is, and having again grown up in this industry, structures within the services industry in and of itself can be prohibitive towards women or even minorities getting ahead. And something as simple as the trading hours, right? If you're a woman, a mom, I have 5 kids. I was never able, when I was pregnant, to be able to make market open. But if you are rated on your performance as running a trading desk, how could you be the best person on that trading desk if you've got to drop your kid off at market hours? Or if you're on the West Coast like I was, you're in the office at 4 o'clock in the morning. And so one of the firms that I worked with, when we were really trying to figure out what were the strategies that was hindering women in our space, we recognized that it was first what we were rewarding. And it was rewarding based on the structure of the way the job was defined. And so if you are running a service desk, as an example, and the hours require certain performance measures, is that fair to everybody across the table? Or if you're a sales manager and you have to hit conferences 60% of the month, is that inclusive for everybody at the table? So I would say first, one of the great things that I think that we as women can challenge in our industry is our structure for all of our women in every single facet of this industry Does it allow for us to compete at the same rate that it is for men? And I would say conclusively no. And so how do we as leaders in our organizations challenge those norms, still find ways for women to be competitive, but not being detrimental to, especially if you happen to have to take care of children or caring for others. So I would say that's number one. And then number two, I would also highly suggest that as we're mentoring women, and especially those in the next years, and I've heard this from my millennial daughter who says, Mom, you always tell me the way things used to be. That's great, but that doesn't do anything for me right now. I would agree that because we haven't seen the tremendous growth for women in the industry, that they are facing different challenges. And so really understanding as we're mentoring and advocating for our women and those women that are moving into these management spaces, what is it that they need? The McKinsey report shows us, if you haven't seen it, the Women in the Workplace report last October was fascinating. It talked about the broken rung. And as I had stated before, women have a precipitous drop at the management level. We all enter equally into the workspace between men and women. Once it hits the management ranks, it drops. It goes from 50-50, and then we drop about almost 20%. And that's because the same measurement tools that I was talking about are women being given the right jobs and the right tools in terms of measurement. So pushing through, helping our young leaders to figure out ways that they can actually get to that next level, I would say, are things that we could all do in this room.
Now we have a little bit of a different format for this discussion because we really want to make it very interactive and bring the audience in. That's part of our mission of educating and amplifying. So if there's mics that are set up, so we definitely encourage anyone who has a question and would like to engage further with Mona Lisa to please ask a question.
Or Kate as well. I think we have a microphone there and up there.
I'm a lawyer, don't make me call on somebody.
I think we're going to, Joyce.
Now, Mona Lisa, thank you so much, and thank you so much for this session. Could you maybe just share some examples of like best practices that have evolved since the pandemic? You know, perhaps they were temporary, have become permanent, and like just things that you would suggest to companies to put in policies that are more inclusive and sustainable, but still commercial. Like, what have you seen change over the last couple of years that you would kind of outline as the best practices?
Yes, a big pet peeve is, does everybody need to have a 7:30 a.m. meeting? Something as simple as meeting practices, I have seen be very inclusive and being very effective, because let's be fair, I think if we took a poll, I don't think we all feel like we sit in meetings that are very effective. But when you're really looking at young leaders and you're looking at individuals who are really trying, if you're really trying to support a growing leadership group, especially in cohorts that are underserved, sometimes these meetings don't make sense. Or are you having meeting times? It's something very basic, but one that I have found in organizations we've worked with, become very effective. And the first thing that it does is it actually gives people the permission to say, do I need to be here, right? And you'll see meetings, and I have a mandate. If there's 400 people in a meeting, who's talking? And if that person's talking, do you need the other 350 people, right? And so giving people the permission to decide whether they need to be in a meeting, I think also helps with the ideals of we're all struggling with the going back into office and not going back into office. Having, I think Citi has done this and other big institutions have done this. Do you always have to be Zoom on a Friday, right? So I think that those basic practices, and the reason why I highlight those is, for those people who are really struggling to bring their careers up, this on all the time, juggling other things is where I think where women really are having that tough time. And we have found that many women are in full agreement. If you just give me a breather, no different than if I was at work, I would be so much more effective.
And one of the things that we've also seen is the idea of, parental leave being for the primary caregiver.
Yes.
As opposed to just being gender-based, because there are actually studies in academia that fathers would take their parental leave and use it to do additional research, where mothers were taking parental leave and then actually being the primary caregiver. So it was something that was intended to be equal, but it had a very different consequence depending on who was the primary caregiver.
Yeah, I'm going to double down. The other thing I forgot to mention on this is women in this generation are now becoming more primary caregivers for their aging parents. And so it's not just children, it's also parents. So even if you don't have children, the burden of primary caregiving is on women's hands down. So if you're a working mother or taking care of a parent, these practices, I think, will help women in our industry.
Kate, Melissa, thank you both. Kate and Melissa, thank you both for bringing us into this important conversation. This is Kat from JP Morgan. I would love to hear from you on some of the best practices for bringing men into this important conversation, because I think we all recognize what the complexion of management teams as they look now, we can't do it alone.
Go ahead. So I would say for the industry specific, I think for financial services being very focused on just job growth and promotions, I do kind of going back to the conversation about when we are sitting in management meetings and discussing how to promote or potential. I think MIT just did a study last year that said that women tend to get rated in the 9 box. We all love that 9 box rating. Women tend to get rated higher, if not, or at the same with men in terms of performance. Great. But promotions are done on potential, which men always get rated higher on potential. And one of the things that they believe is that's because of unconscious bias, because when potential is unconscious and it's subjective, and so you naturally see a man progressing into a potentially bigger space, and women, there's not enough out there. And so going back to your answer is really pushing on the narratives around when you're sitting in these rooms and having the conversations about who should be up for a promotion or who should get that next assignment, or even just feedback. Like when you really listen in and you hear another male leader talk about how Jack was so awesome, he was like hard elbows, really giving it to the other guy, but would he use the same thing to discuss Samantha? And I do think that that's our moral imperative as women leaders to kind of saturate this kind of thinking. I do it with my husband all the time. Every single time when he says, I'm like, well, would you say that about our daughter? But he would even say, I don't even realize the things I say or the ways I think. I think that's one way, is to kind of lean into that. And then secondly is to look at the areas where you do have male-dominated structures in terms of your teams, and ask yourself, and ask the guys in the room, what do you think it is about the way we do business that no woman wants to apply to the group? And are we really getting the best out of us from a diversification of talent?
Yeah, I think it's really is looking at the norms that you're creating in the workplace. I'm on the board of trustees for my college, and our president was telling a story about there was a department head who really hated any kind of social interaction. But the younger people on his team were like, well, that's really how I'm going to get better. That's how I'm going to network. And it got to the point where the women who were in the department were actually telling women who were applying not to go to that school. And they were like, wow, we've got to be doing something wrong if these incredibly talented women don't want to come to us. And it was really looking at the environment that had been created. And maybe a senior man would have discounted something because it wasn't important to him, where it was very valuable to any young women who would be in his department. So I think you constantly have to challenge the environment that you're creating and making sure that it's working for anyone who wants to be in that space. And I think that anyone can be an advocate in that space, regardless of how you identify.
There's one in the front.
Oh, hello.
Yes.
Okay. Hi. Thank you both, Kate and Mona Lisa. My name is Melina Dennebeim, and I am from actually Columbia Business School, where I direct the master's in financial economics at the business school. And so my head is filled with amazing admissions candidates right now. We're in the thick of admissions. And I run the program, all components, marketing, admissions, and then career placement, as well as curriculum and research. So I see the problem going back, the female representation and promotion going back to the issue of those stringent STEM requirements and recruiting into STEM studies in the US. And for example, our candidates need to have linear algebra, multivariable calculus, econometrics, even to be considered at a baseline, including coding. So we look at applicants, and they're primarily from China and India, and 50% are female, at least 50 to 60%, which is great. But we have so many talented people coming into this program who are not from the US. And when I prep them and move them into the career segment of the program, which really starts from day one, I see their challenges not just day one and year one, but year 5 to year 10 in their careers, which has to do with not being an American-born female. And I'd like to get your perspective on how you think about these issues in terms of finding the voice and finding your value proposition and being able to vocalize it and understand the American way of doing business for women who are not born and raised in the US, or maybe who have come here to study undergraduate but are now entering into the workforce in the US for the first time.
You want to try that, given your perspective? Sure. I can do it too.
Yeah, no, I think that that's really a very important question in terms of how you build allyship in an organization, and that you respect and you recognize people's differences. And like I said, just looking at the group as a whole and realizing what all the needs of the group are so that people do not feel isolated, and recognizing that many, people, I remember as a young attorney, I would walk into a room and I'd be the only woman in a room. There could be 50 people in there. And that's hard unless somebody says, well, hey, come sit next to me. Can I get, you want to get lunch? What did you do this weekend? I think it's just creating community, but also recognizing and honoring people's differences.
Yeah, and I'll take a different approach, really. So my daughter graduated with her master's from Columbia, and I'm still paying for that, by the way. But great degree. So what I would say is coming from a minority perspective, and very specifically, I'm AAPI, so Pacific Islander, and there is a lot more stress of STEM in foreign countries than it is here, and then making the transition here where it's more acceptable to be more, I would say, well-rounded and maybe not so studious. For your students who are struggling here to find their voice, I can absolutely sympathize with that. One of the women on our board, Cindy Chendelano, has really educated me on the plight specifically of Asian Americans in the United States, the bamboo ceiling, and there's this perception that they're smart, right? So that's it, and leave them alone, but there's nothing else to engage with them there. And so we've been, and that's part of what we do at IDIF, is making sure, not only from the women, but also from the underrepresented minorities, like what are all these unconscious biases that are making it difficult for your students from abroad to interact with students in the United States or even in your programs. I would say one of the things that I know that I've heard from international students is even it's something as simple as the jokes or the things that you had learned in your undergraduate year. Those are completely foreign concepts. Like our undergraduate programs look nothing like they do in foreign countries. So I would say even from that perspective for Columbia or any institution is how do you integrate those students? But it would also require us to come out of our own spaces to actually empathize or sympathize on what it must have looked like from them coming in, and how do we then build a coalition or even just a bridge to help them feel more welcome, because you don't want to lose that talent. And then that's going to carry with them into the workplace, and that's something if we could head it off over in the graduate programs, I think would be great.
I haven't asked one. Yeah, hi. My name is Li Chawang. I work for the Fed. Prior to that, I was a structured trader. Worked at started at JP Morgan and at Bank of America and Credit Suisse. For many times, I'm the only female trader. And by the way, I'm from overseas as well. So for whatever you describe, I have to spend my time to learn about baseball just to have just to have a conversation in the bar with all the male traders. And at the Fed, I joined the Fed about 5 years ago, and I think the diversity here are much better. I just want to say, as everybody mentioned here, I have a question. My question is, so Facebook Sandra wrote book Lean In, and then she mentioned the woman can have all. And the Coca-Cola CEO mentioned women actually cannot have it all. I want to ask your opinion on this topic. What do you think about this question? Thank you so much.
Well, I think that women can have it all, but probably just not all at the same time.
Yeah.
And it's really about kind of prioritizing. You're really prioritizing what your specific goals are and what you want to accomplish at a specific point in your life. And then realizing that that might put something else on hold for a while, but that's okay because that's your individual choice. And there's no one path to success. My path is not going to look the same as yours, but I think it's very important for people to always be chasing your own brass ring. Don't have people tell you what your priority should be, and just realize that sometimes having one thing or another, you can't always do 10 things at the same time, but you have the right to choose what your priority is at any moment in your life, and also have the confidence that you can do something else if you want to.
I agree. I feel very blessed to have been born into the supreme gender, to be honest. Sorry, just kidding. But very honestly, very proud of, women are superheroes. We are, for all the men in the room, first off, thanks for coming. But for the women, the things that we can multitask, the things that we know how to juggle, the things that the gut instincts we have, if God asked me to come back again, I'd say I'd be a woman hands down and a minority one. Because I'm so proud of, I think, just of what we're able to accomplish and literally take on as individuals. But to your question very specifically, I agree with Kate. I don't think it's a fallacy that women can have it all, but to assume that you could do everything, you're going to overwhelm yourself. And even if you achieved every single thing you wanted at the same time, you're going to be tired. So did you really enjoy yourself, or now you just want a break or a spa day, right? So prioritize what matters most, and most importantly for women, let's stop neglecting ourselves. That is, I think, rates number one in female traits sometimes is we deprioritize our mental health, our spiritual health, our happiness for the sake of a job, a family, and everything. And I'm all about the prioritization of a woman to herself. The yield on that is tremendous. And so you can't achieve it all. Just take care of yourself first.
Thank you. I remember I had the pleasure of learning about sports as well, but I refused to learn baseball until everyone learned cricket.
There you go.
I think that stopped that conversation. Thank you very much for speaking to us today. As you think about education and amplification, are you seeing any interesting work being done around workforce development, or even some parallel work around building that soft skills or mentoring that actually works? Just any thoughts on what you're seeing as you talk to people?
So we see that mainly being focused, in fairness, at the individual corporate levels. And so there's the ERGs, and then there's what we would call sister companies, and their sister nonprofits who are really focused on diversity or amplification of women in financial services, whether it's the bond market or traders or you name it. In those sister organizations really focus on the tactical of how to move women forward or how to move minorities. On the flip side, organizations, whether it's JP Morgan or the Fed, what we're hearing, and we're starting to do some work on this, is on these ERGs. And what we're finding is these individual, for those of you that don't know, the ERGs, the employee resource groups or business groups, I think is a great tradition that's being started among groups where they are tackling mentorship and what are these strategies. And so what we're seeing is that they're being very localized in how they're approaching, which I think is great because every corporation has its culture, but we're still hearing the same things, right? You still need to see people for who they are, meet them where they're at, and then also doing a very concerted effort every year, what ERGs and BRGs are doing, is having goals. Like, what are we trying to do as an organization to further, whether it's mentorship, whether it's more inclusivity for this ERG or BRG, and that's more thematically than we've seen at the ground level. But if there is studies that you've heard of or anyone, share it with us and we'll amplify.
Thank you. I'll ask the last question, so I know we're on time. But one of the things that we are running into, I think, when we think about inclusion are generational differences and motivators. I think for many of us who did our time on the trading desk, you got in early and you sat there and you did it. And that's just what you did. But we're finding kind of the younger generations are questioning, well, why are we doing that?
Mm-hmm.
What advice do you have to give to everyone in the room about how to bridge the differences and still have a sense of inclusion, but also, making sure the work's getting done?
Are you talking to my kids?
I don't know how old your kids are, and I'm worried about my kids.
Kate, we could both do this, but so bridging the gap. I think it goes the same place it does when you're trying to understand people from different diverse backgrounds as well, is when you, at least from my perspective, when I have heard I don't understand why I'm doing this, I try to go back to why they're asking. Well, turns out in school we taught them to question the value of everything, right? So they go to great schools, they do great things in universities, and they're told, you need to do something that you value, something that shows your value. And that's great that we taught that, but corporate America never caught up with that value proposition. We just said, here's a book, learn it, and your value proposition is when you get your salary at the end of the year, and hopefully you get a performance review, right? So there is a disconnect, I feel, generationally between value in what those of us who are older are used to. You prayed you got a performance review. You prayed it wasn't a surprise, and you hoped it came with an increase. That was the value proposition we saw once a year, if we were lucky. This generation, they're asking value the entire chain, what they're being trained, and that's not a bad thing. It just means that they're coming at it from a different expectation. I do think we have to have those conversations early. And I do this when I'm training somebody who is of that perspective. I make sure to say, okay, we're doing this because X, and let me level set. You're gonna be doing this for about a month, 3 months, a year, and it's not gonna make sense, but let me explain to you the value on it. That is not a conversation I've ever had with any boss ever in my life at any given point. But I do think it's important if we wanna retain some of that great talent that has value inserted in everything they do now.
Yeah, I think that's really important. I always focus with my more junior staff on saying, I'm going to tell you the what, but I'm also going to tell you the why.
The why.
And so that way you can continue to grow and understand. You can fill out a form and file a 13F, but if you don't really understand, like, well, why are we doing this and why is it important? I think that can really motivate people as well.
It does, it educates them. I think we did it in time.
Yeah. Thank you very much.
A couple minutes to spare.
Anyone have a question that's like with less than 2 minutes to answer? Go one more.
Yes.
It's not really a question, but I just wanted to add on to that last point because I have to deal a lot with the younger generation. And in addition to the great points that both of you made, I will also turn it back on them and I will ask them, how do you think we should do this?
Yeah, I agree.
And it's really validating. And most of the time they come back to where we started.
We have one more. Thank you, Susanna.
My question is extremely similar. My name is Anusha Raina. I'm a credit analyst at S&P Global. And I found it really resonated with me that you mentioned the habits of the workforce are not conducive to most women's lifestyles. I mean, even if you think about it from like like a hormonal perspective. Like within those 3 weeks, we have so many ups and downs, and our motivations change, and we want to cry and lie in bed half the day, and then another day we want to conquer like all of our monthly goals in like one day. So it's like navigating that, and then as you get older, you have like family responsibilities and your parents, like you mentioned. How do you think that can see change in the near future? And how do you think we need to go about that? And how do you think a junior person can go about that? And then also, like, do you feel like there will be room in the future for women to innovate business segments and innovate industries instead of having to, I guess, mold into kind of what already exists or like male-dominated industries? And I guess what would that look like? Thank you.
What do you want? Yeah. I'm going to try to answer this with the time. I think we're there. I think we're there doing the work. But like other things, this is going to take time to bake. And I know I could hear my daughter saying, "Mom, don't say it again." Where we were and where we are is different. It's not as fast as we'd like it to be. But there was a time, I won't name the firm, that you had to wear stockings just to work as a woman.
Oh, yeah.
And that was when I've been in the industry. So we've made tremendous strides. It's not enough. I'm not excusing it. But what I would say is there's a number of executive women and women leaders in this space that are doing the heavy lifting, that are sticking through the broken rung and hanging it there, or they're coming back after the rung has dropped and starting their careers over. And for you as a young analyst kind of growing into this industry is definitely mentor with them, and they will help you navigate your own organization better than any of us. I could give you some great advice, but I'm a huge proponent of finding an ally also that sees the work that you do and can also help you kind of move that. And women, we already run the world. We're just so nice we haven't taken over yet, but we do run the world. Don't worry about that. We're at time. Thank you.
Thank you.
I will say thank you because I'm not wearing stockings today. So team, no stockings. Not for lack of trying, they ripped. So thank you all so much for coming. I'm Jessica Broughton. I'm the Vice President of FIASI, and I have the esteemed honor and daunting task of wrapping this in 2 minutes, right, Kayla? That's about what I have. Okay, so indulge me, trip down memory lane, because the Women Fixed Income event was actually my first event of FIASI a number of years ago. It was virtual, so a little bit less dramatic than at the Fed, but still impressive. And for me, it was really the first conference of its kind that I, had encountered where you talk to all markets, and as Erin mentioned, panelists just happened to be women, but it was all women. And so I walked away from that thinking, sign me up. And spoiler alert, I did sign up, and I went all in. And so now we're here, and we're closing the 6th Annual Women Fixed Income Conference. We co-hosted it here at the Fed, which is arguably the arbiter of fixed income markets, so it feels pretty apropos, particularly when you think about where all markets are focused on, the path of rates. I had a lot of takeaways. I have a lot of notes that I took, but one of the ones I took away is 2024 is going to be a pivotal year. I think, Suzanne, you said a treading water year or the carry year, although I liked Argia's comment, and it's what my kids say, the "are we there yet" year. So that's what I'm going to go with. Whether it's a pivot in rates, inflation, credit, government bond supply, geopolitical risk. I don't know if Ellen's still here, but she had 50 criteria. I'm not going to list them all, but it feels like everyone's waiting for the other shoe to drop or rates to drop. So I don't know the answer, but I feel confident everyone who's spoken today, that's who we should follow, because they're going to know the answer when it comes. Special thanks. We've already made it. Joyce, thank you for all that you do for FIASI, for Women Fixed Income. Michelle and Julie from the Fed, thank you so much for co-hosting us. Kayla, Maylene, Connor for making this happen. Lauren Nauser, our executive director, you literally keep FIASI running. We would be lost without you. The panelists, moderators, all of you, thank you for staying. For those of you on Zoom, also thank you for staying. Hi, Mom and Dad, maybe you tuned in, I don't know. If you're not a member, please be a member. Like, subscribe, share, whatever they say at the end of the podcast. We have events coming up next week. Dan Fuss, please tune in.
And then my takeaway is from the panels, take risks. When there's a door shut, find a window, challenge the norms, and spread the love. So thank you all.